it's almost like we've taken 2000 and 2007 and squished it together here in a horror, what do you call it? Play of horribles, because we've got a tech bubble from like we had in 2000, but at least the real estate market wasn't in a big bubble in 2000. It had been coming down. And here we've got the real estate bubble and the tech bubble at the same time, after years of zero interest rates. So I just think that the financial risk has never been higher, just as people have never been older in terms of, the bulk of the owners of the equity market and of anything on that in the financial product sector tends to be the over 60 crowd. And I see things, and I've talked to people, they send me their portfolios, they're 70 years old, they're 85 to 90% in equities, and maybe they have 10% in some high yield debt or a high yield debt fund. And you try and say to them, this is insane.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. After a year of projecting confidence in America's strong and resilient economy, at his recent Jackson Hole appearance, Federal Reserve Chair Jerome Powell suddenly changed his tune. He expressed concern about the deteriorating labor market, saying the situation may warrant a resumption of monetary easing, notwithstanding the potential inflationary risks of tariffs. Now, this comes at a time when stocks are at nosebleed valuation levels, with the general public more exposed to them than at any time since the 2000 and 2007 bubble peaks. So, are investors sleepwalking into an oncoming painful market correction here? To find out, we've got the good fortune to welcome Danielle Park back to the program. Danielle is President and Portfolio Manager for Venable Park Investment Council, where she manages millions for some of Canada's wealthiest families. She's also proprietor of the daily financial website, jugglingdynamite.com. Danielle, thanks so much for joining us today.
Always nice to be back, Adam.
It's great to have you back, Danielle. You're definitely a crowd favorite here. It's been way too long since we've had you on, so hopefully everybody's very excited that we got you back. Look, a lot to dig into here, and you've been very kind in preparing a whole bunch of slides for us. So I don't really want to get in the way of them. And so I guess real quick, before we just let you run on the slides, high level, what's your general take on the macro situation today?
Well, it's extremely volatile. I think that's a simple statement. I would say that I think that the focus on tariffs is overdone. In terms of concern around inflationary impacts. I think the greater theme is the real estate downturn, which is unfolding in both Canada and America and other countries. And I think that that is likely to have more of a sway on the economic picture, the employment picture going forward than the tariff file. However, it is continuing to undermine confidence, undermine business investment, many things that would be better if they weren't negatives right now. But I think that it's an irritant rather than the main theme.
Okay, and not to steal your punchline from your slide presentation, but right before we turned the camera on, you sort of said in exasperation, I'm so tired of the situation. I just can't wait to be bullish, but I can't be there yet. So is that kind of a true sum up of where you are right now?
Yeah, I'm a very optimistic person by nature, and I like to be optimistic. I like to look on the bright side. But unfortunately, my day job is a risk manager for life savings. And so I have to be focused on what can go wrong. And right now, that is the dominant set of factors I see are more negative than positive. And that requires me to, focus on them more than I otherwise want to.
Okay. All right. Well, look, why don't we get to your slides here? I'm actually very excited to hear your thoughts on the housing situation when we get to it, because it's something I talk about a lot on this channel, and I believe that the negative wealth effect from a housing market correction is more substantial in terms of what's going to happen in the economy than say a correction in the stock market.
Absolutely. It's the most widely held asset worldwide. And we know that the bulk of the wealth of the country, of the private sector, is certainly in the real estate market. And it's also the most widely levered market in the world, as you know, because most people use debt to buy it. And so that makes it extremely important when leverage is positive, but also a negative when leverage turns the wrong way.
All right. Okay. Well, look, let's not waste any more time. Let's get straight to your slides.
All right. The interest rate cycle has been really pronounced in the last 15 years, as you well know. And that is reflective of the fact that, so much was done after the GFC to try and stimulate the economy that interest rates were slashed. And we see this chart of the 10-year Treasury. Of course, the Fed and the central banks don't control the Treasury rates. That's done by market forces, but they certainly have an impact on the short end of the curve. And the US 10-year, now at 4.28, is the same as it was in August of 2007. So I thought that was an interesting jumping off point because, again, back in August of 2007, we had a massive housing bubble in the United States, which people were still largely bullish on, even though there was defaults and various factors eroding under the surface. People were generally saying, things are well. And it was a good thing for income, for those with savings who were able to generate more than 4% on treasuries and safe deposit CDs, that sort of thing. It was a positive for those spending interest income. And it is today as well. It's good for that cohort who is able to have capital in safe deposits and get interest bearing. It's not good for borrowers, though, right? So this is the major factor here. The 30-year fixed mortgage rate at 6.56 today is more than double where it was in January of 2021. And that is a major factor that is starting to unravel throughout the housing market. When we see that in Canada, indeed, the same sort of thing has happened where mortgage rates have doubled from the bottom, which was in the first quarter of 2021, when people here were able to take out fixed 5-year mortgages, which is the most common term in Canada, fixed 5-year mortgages at less than 2%. And they were doing that with both hands and feet. It was a real boom in our real estate market. Now we have seen, of course, with rates coming up in the last couple of years, they're now around 4%, which historically is not that high, but it is significantly more when you're having to renew at these current rates. Another thing I'd like to point out with respect to Canada and the United States is that even though your mortgage rates are considerably more, 6.5% range in there versus 4% range in Canada, our housing market has not revived. It is not taking off and doing well now that rates are back in the 4% zone, even though they were, up above 5 at the peak of the rate cycle. So I think that's instructive and something we should keep in mind.
So let me just note one thing for our American viewers, just to make sure they're aware of this. So the chart that she just showed was of 5-year mortgages, and Canada has a different lending setup than we do, where mortgages tend to be a lot shorter there in Canada, where in the US we're very common, the 30-year fixed mortgage is very common. And what's important to note about that is you have, essentially what, 20% of the, roughly, of the houses in Canada coming up for refinancing every year, right? So you're feeling the effects of these higher mortgages faster in Canada than we are here in the States, because we still have a ton of people that are sitting on a 3% 30-year fixed mortgage, and probably will for a long time.
Yeah, and so the gift that keeps giving here is that the ultra low interest rate period ballooned home prices more in Canada than even in America, but extraordinarily. So in 2.5 years, our median home prices went up 40%.
Wow.
While the average pay for private workers went up 12%. So right in there is the crux of what's happening to us now. That was already quite expensive to live in Canada. Housing was already in a major upcycle since 2008. We didn't have the big crash that you had in America, and our prices were already going up. And then this was just like the cherry on top, this ultra low rate frenzy that went on into the peak of 2022. And that's what really drove affordability to impossible levels. The next thing that happened was, of course, that our economy became extremely concentrated in terms of the amount of money that was going into housing as opposed to other sectors of the economy. And I was pointing out at the time that this was a big misallocation of capital because it was highly inefficient, right? I've said this before, but an abode is not more efficient when it costs $1 million or $2 million than when it costs 500,000. It's still just your shelter, it's consumption spending, it's where you live, it's lovely to have, but it's not going to drive the economy in terms of efficiency or innovation or new technology. It's none of that. It's just places to live. And so the fact that our GDP became more concentrated in the property sector relative to yours, at the peak of your 2006 bubble, you were at 6.7% of GDP was in residential investment. We got to 9.3 in the first quarter of 2021. And at the time, that was basically driving all of the economic growth in Canada. There was really very little growth coming from anywhere else. It was the highest in at least 60 years and nearly double the long-term average or norm, around 5% being the investment quotient going into residential real estate. So again, for those of us that were paying attention, we were trying to say, this is not healthy. This is going to be a problem later on. And part of that was looking at your experience after the GFC in the blue line there, when the mean reversion began in terms of investment in that sector, when it was clear that there had been a huge overallocation to residential real estate and things went into a free fall. And of course, then everyone pulls back on new permits and building, and you get a contraction in employment. And it tends to be a very cyclically negative impact for the economy. And so we were concerned that this would be, in fact, with spades in the same way with the Canadian cycle. And indeed, it's turned down just in the last year or so. From that peak in 2022, we're now seeing that investment sector for housing come off. But the aftermath of that, of course, is that Canadian households now have the most debt they've ever had, more than 100% of GDP, which again is, you guys peaked around that level briefly in the peak of 2006 in your craziness. And then, it has been falling off since. So Canada has now surpassed that in terms of the household sector, and 74% of that is in mortgages. So it is sticky debt. It's hard to retire, and it's kind of sitting there like an anvil on households and on the economy overall. So when we look at housing affordability, this just gives some perspective, but basically the effect of having, as I say, the affordability crisis today is not so much that interest rates are at 4% or around there for mortgages. That's pretty average and benign for any of us who came into the housing market in the 90s and remember much higher rates. But as a percentage of the median household income, we've got the worst affordability that we did since 1980, when mortgage rates were, 17, 18%, and that's fully a function of the prices being just ridiculous. And so, long-term affordability for shelter costs is considered, 30% of your disposable income. And that's supposed to include your property taxes and utilities, Adam. And we're at 58% nationally just for mortgages today. And in the major centers where, 80% of the population in Canada, just like in America, lives in the major urban centers. Well, in Toronto in particular, 78% is going to just housing of the median household income to the mortgage, and almost 100% in Vancouver. Like, it defies any kind of reason. It's just craziness.
That is bananas. Yeah.
It's truly bananas. And this is what you were alluding to partially, is that 2/3 of Canadian mortgages, because they were all refining, and buying properties when mortgage rates touched the lowest ever in history, below 2%, 5 years ago, it's no surprise that those 5-year fixed terms have been coming up for renewal in 2025. And a bit more than half of them are going to be renewed by the end of this year, and then the remainder in 2026. So we see that big bulk. And I remember looking at charts like this in 2006, 7, 8, Adam, you probably do too, about all the refis coming up in the American market and how that was like the pig in the python, kind of thing going through, where, you had to get refied at current rates, and that was going to be a problem for a lot of people.
Yeah, there was a famous one by CS First Boston, I think, and you remember we had a lot of these ARM mortgages too, right?
I know.
Yes. Yeah. So anyway, so okay, yeah, we're seeing the reckoning, the timing of the reckoning right there.
Yes. And so we've got the highest inventory of completed unsold homes nationally. This is a US chart, but the Canadian stats are about the same. And of course, the home sales in Canada are actually the lowest they've been since 1990 in major urban centers, which is wild when you consider, like in places like Toronto, the metropolitan, the latest census says that the population increased 72% since 1990, and yet we've recently had 32% lower sales than we've had for the same month in 1990. So
Okay.
it's really just frozen up. The movement that we are seeing is in the first-time home buyers that have been waiting on the sidelines, sort of anything under, significantly under $1 million. The tiny condo market in Toronto, where, a couple of years ago, they were trying to sell them for $800,000, and now they're selling for around $500,000 to $600,000. There's some of those things being sold, but basically the bulk of the housing stock is in the more than $1 million range. Indeed, more than $2 million has a huge amount of properties. And I'm talking about not just in urban centers proper, I'm talking about in commuter communities, an hour north where I live, or in cottage country. It was very common for prices there to be more than $2 million during the ultra low rate frenzy. And those are the ones, if they're for sale, they are literally just sitting there. There's several on the street where I live, which is a waterfront street, lovely, top tier properties, but asking multi-million dollars, and they haven't had any hits in more than a couple of years here. So it just shows that even the high-end markets are not immune from this kind of thing. And I think it's very interesting to look at. This is a chart of real residential prices, so adjusted for inflation, and what they've done in these past cycles. Now, I happen to think that this particular one is most akin to what happened in the 1980s, certainly in the early 80s when we had a major housing downturn. And Bank of Montreal recently came out with a report that just pointed out that Canada is often a bellwether for the overall North American trends for housing. Now, we dodged the bullet in 2008 because we didn't get so over our skis. We were headed that way, but we didn't get there before the GFC burst. So that really saved us, if you will, at that point. But in the early 80s and in the early 90s, we had similar downturns as you saw in the United States. So, and the point I like to make here is when you see that for 30 years, the average or real rate of appreciation for real estate was less than 2%. From 1970 all the way to 2000. Then you get into this hyper period of 10.3% annualized gains from 2000 to 2006, which is, of course, as we know now, it was a bubble. Then you see that mean reversion through a 39% correction that happened over 6 years. And I think that's an important theme here, is it's a multi-year event that happens. It's not something that, it's not a 9-month bear market typically. It's something that happens and it takes many years to play out. And that sort of surprises people that aren't aware of the historical record. And so you've seen some rebounding in prices, of course, in the last little while, but still, I think by having come up about 4.1% since the 2006 bottom, we're still quite a bit above the historical norm here, about twice the historical norm on a longer term basis. And that's why I think that America, although not as bad as Canada, has certainly got overpriced again in the last couple of years for many of the same reasons, just all the handouts, all the stopping of foreclosure procedures, letting people not pay their mortgages for many years, like all these political decisions that were quote unquote to help. I get a kick out of the help when oh no, I've triggered confetti there, I'm sorry. But the help that comes from governments around housing tends to be deadly in the end, because it just is always focused on how do we get home prices higher? How do we stop them from going down? How do we build more so we can sell more? That's typically the approach that is taken. So if we look at the Canadian experience so far, So on a nominal basis, prices got, the average sale price was 817 in the second quarter of 2017, and it's come down recently to about 680. So we've had about an 18% correction on a nominal basis. On a real basis, we've already come off about 23% from the peak. But again, if we look at the overall, we're still extremely priced relative to rents. The numbers still make no sense. You still can't buy a house at current price levels and interest rates and rent it for anything close to what it takes to carry the property, never mind maintenance and all that sort of thing. So, and in terms of the ratio of income, it's still the average median sale price in Canada is still, 6 times the household income, and in major centers still north of 8. So I think that this period of correction, which is now 3 years and counting, is more likely to resemble what happened in as I say, the 1980 and 1990 downturns that took 8 and 9 years to complete. So if we've already seen this level of mean reversion in the first 3, I would submit to you that we could see quite a terrible grind here for people that are unprepared for this particular cycle.
Okay, so basically, you'd love to be more bullish, but kind of years of pain ahead if you're looking at the housing market.
It's a slow correcting asset class, right? Because we've seen that, as you know, in America as well, that builders have been, doing all sorts of incentives, and they've been buying down mortgage rates in both Canada and America. Builders have been offering mortgage rates in the 3% range, and yet housing sales are still at 30-year lows. So it's not just a function of lower the rate. And when the central banks start cutting, it's not going to be a quick fix. It never has been in these past cycles. And what we know is that for the reasons that I sort of touched on with respect to, the most highly levered asset class, the largest cyclical driver of growth in the economy, housing tends to lead the most severe and longest economic downturns when it starts to mean revert. And I think that's definitely what we're into at this point. And then, one of the other factors that helped drive the prices higher, of course, was a massive influx of immigration, which has driven, 80% of our population increase since 1990 has been through immigration in Canada. And you've had a similar influx of immigration, at least up until the last year. And that has helped to provide, because as you know, our birth rates are not replacement levels. So the only way we've been able to get population growth is to have this immigration. But we also sort of did that to a wild extreme during the pandemic, and it kind of distorted everything in terms of making rents that much more unaffordable, and driving some consumption-driven impacts through the economy, which helped offset some of the other slowing that was happening in other sectors. But now we've got a full-on reversal of immigration. And, again, the greatest parts of the population of the country live in Ontario and British Columbia. That's where most of the immigration went to, particularly more than half went to Ontario, where I live. And that was why we saw those property values and rents go up the most in those particular areas. And it's also why we're starting to see the mean reversion be that much heavier in those particular provinces. So it's expected to be this negative reversal of immigration is expected to continue through next year, similar kind of to what you're seeing in the United States as well.
All right. Can I ask a couple quick questions about this? And I don't want to rat hole in it, but I don't have as good a picture of what's going on immigration-wise in Canada as I do here, obviously, in the US.
Yes.
So much of your immigration numbers you just showed there, that was predominantly legal immigration, right? You guys haven't had the surge that we had in illegal immigrants over the past 5 years, correct?
Yes, it was predominantly legal, but it was it was a concerted effort intentionally by the government to try and offset. I think they saw the weight of the boomers and the weight of the housing bubble deflating, and they got concerned. And they said, we're going to have to get new blood in here to try and help pay the bills for the old folks. And they really doubled down on not just legal immigrants, but a lot of students were attracted in droves. And some of it was fraudulent. Some of the schools that were pounding the pavement all over the world, bringing people, especially from Southeast Asia, were doing so on false promises of, access to the Canadian job market and how wonderful it was going to be. And some of those people are reversing of choice in the last while because they found quite the opposite. They found that it was very expensive and very difficult to get integrated and started here. And then also policy-wise, we've done a reversal.
Okay, and that's the second question, which is, yeah, so I mean, in the US, very famously, we've slammed the border shut. The illegal immigration flows have stopped. What have you guys done in Canada?
Basically that. There is some positive immigration still in 2025, but it's been sort of tourniqueted to a trickle. And that's partly, there was just such a public uproar about the deteriorating job market, which has been declining. Our unemployment rate has been going up and our workly wages have been going down now for many months. So there's that, and also just the outcry about the affordability crisis with housing and the impossibility of people just being able to live anywhere near where they were hoping to work. So that sort of uproar caused the government to retrace its steps.
Okay. And I didn't hear you use the word deportation. So I'm guessing the folks that made it in there in the surge over the recent years are still there. So now the challenge is sort of an absorption challenge. How do we absorb these people into the economy in a way where, yeah, it's kind of flooding the job market right now and whatnot, but we'll just have to work it off over the coming next years.
Yes, we're not doing the sort of violent round people up and ship them out on planes that you're seeing,
Right. Well, because
in
they're
South America.
legally there in your case. Yeah. Yeah.
Right, right. Yeah.
Yeah.
So again, this is just about why the public was in such an uproar. The ability to rent just became, to buy became impossible. And now the good news is with the reversal in immigration and the influx of properties that are being listed for sale now, because people that were, lots of properties were on negative carry back in 2022, even with mortgage rates below 2%. Now I was looking at proposals and, people wanting to buy or having bought or balance sheets. I was looking at all sorts of things and saying, this doesn't make any sense. You're subsidizing your rental property, so much, hundreds to thousands of dollars a month. It makes no sense. Well, that's got a lot worse, as you can imagine, since interest rates have now doubled since the lows. And as more of those properties come up for renewal, I'm talking to people every day who are saying, well, we're just going to sell it. We're just going to sell it because it doesn't make any sense. And, why would we subsidize it? Because now they get a notion that property prices have been coming down since February of 2022. And so their appetite for subsidy is no longer there because,
Right.
why would you do that if you're just losing value? So you're starting to see more people just planning to sell. And a lot of Canadians, as you know, even snowbirds, as they're called, going to Florida and Arizona, have also been listing their properties for sale, partly because of the stress from the Trump administration and the concern around the border stuff, but also I would argue just as a function of the fact that the Canadian dollar has been weak relatively and the costs have just skyrocketed.
Yeah. So let me dig in a couple of things you said there. So it sounds like Canada has seen the same thing we've seen here in the States, which is, forget mortgages for a second, all the other costs of home ownership have skyrocketed. Property taxes, insurance, maintenance, it's just gotten a lot more expensive to own a home, right? So you're seeing, some additional degree of distress there as somebody who might have even been fine in their home beforehand. It's just like, it's hard for me to hold on to my home now, just with all this rise and all these other costs that I have to pay around it. Now you then add in the higher mortgage rates. So to your point earlier, hey, my 5-year mortgage is ending, and now my new mortgage is at twice the rate of what my one before was. But also, presumably, you're now, these are higher mortgage rates on high home prices, right? So it's like a perfect storm on every dimension, right? So okay, you're nodding as I'm saying all this. You talked about how Canadians are, we're sort of famously seeing in the newspapers here, hey, there's a lot less Canadian tourism to the U.S. and they're selling their snowbird properties here, and to a certain extent, they're saying, well, that's because relations between Canada and the U.S. are kind of rocky right now, and Trump really insulted a lot of Canadians, and they're unhappy with what he's doing, and that's why they're not coming here. I'm sure there's a fair amount of truth behind that, but I wonder how much of it is really due to the fact that they're just economically struggling and they can't, they can't hold on to a second property internationally, or they can't take that, nice trip that they used to be able to do because of the macro issues you've been talking about.
Absolutely. And I would layer on there the reality of the boomers aging. I think we were always going to see an exodus from these southern climes where they have had properties for 20 and 30 years. It's natural at a certain point, the health insurance, everything just compounds to make it no longer attractive to go south. And that is happening, I think, naturally just by attrition of aging out. But it's also been brought to a point now by concern around the economy, the dollar, as you say, extreme weather, hurricanes, all these things have just made it much less palatable for people. And they're thinking, well, I'll just bring my money back. And, they're excited about the fact that, many of them bought when the Canadian dollar was near par, 15 years ago. And
Yep.
now if they bring it back, they can translate that into even higher Canadian dollars if they sell in American dollars. So I think all of those factors. It's funny because I must, each week I'll speak to someone who's talking about selling a US property, and they start to explain to you, it's so cute, why they're doing it. And you think, listen, let me stop you and tell you the 5 main reasons that you're doing this. Like, everyone always thinks they're individuals and unique in their circumstance. And in fact, it's part of a whole generation of people that are doing the same thing at the same time. So that's definitely a force. And the good news is it's getting cheaper to rent. And again, Rick Gurley and Reventure does some of that, showing people where it's cheaper to rent than own.
Yep.
And you would be doing well to take note of that, because it's been cheaper to rent in many places here for some time. And yet the party line, and apparently a lot of parents, a lot of older parents thought that it was really important that kids get into the property ladder, and they did things like take out mortgages on their paid off house or a line of credit to try and help. Again, this help business, goodness, it's going to kill us if we keep helping so much around real estate. But to get their kids into the property market, they were in a frenzy during the peak of 2022 in that area. And of course, all those things are now underwater. Prices have come down. Now mortgage rates are up. Now, the elders wanting to get the mortgage off their house, and the kid can't afford to take it over. And there's a lot of angst around the whole property situation right now.
Yeah. So two other quick questions on that.
Yeah.
One, a big topic, but I just want to touch on it super briefly. Um, I've interviewed several housing analysts recently, and whenever I do, I like to ask them about where are we on the demographic wave of boomers aging out, meaning having to go to the nursing home or to the cemetery, because at some point that's going to start in earnest, and we're going to have 20 years of properties basically getting forced onto the market as that happens, right? And for years they've said, oh, it's going to be a real deal, but it's still years away. And anyways, long story short, Melody Wright, when I interviewed her last week, said, I'm already starting to see signs that it's becoming a material factor now. Like we're in the first inning of it now. Curious if you have an opinion one way or the other.
Absolutely. I see it now. I talk to people every week on this topic, and the exodus is real. And it's for a lot of reasons, but it's all mostly around finance and just wanting to simplify, lower your overhead. A lot of people bought cottage properties, vacation properties, chalets, all these consumption spending things during the peak of the boom, thinking that that was investing and it would all be good in the long run. Lots of people thought you could never lose money in real estate. Well, actually you can, and you often do when you buy it at these peak valuations. So this is some, warnings for people to try and keep this in mind, to try and remember we're probably 3 years into this process that could go on for another few years. And in the process, rents are coming down, which is a positive, which is also a disinflationary aspect, right? Because that's a good part of our CPI basket comes from these shelter costs.
Right.
So
Yep.
it's positive in that sense. It's not great for those that are looking to rent to try and cover the carrying costs, right?
Yeah.
Again, because the carrying costs are up and they can't rent, and now rents are coming down. But this is just, again, back to this point about the demographics of the situation. So, the over 55 cohort is about 30% of the population in North America. They own more than half the housing market, though. And
That's a great chart.
right? And about 20% of them are 1 in 5 over the age of 55 own multiple properties. And these are the most expensive properties, right? Where they've really done them out to the nines with lots of, bells and whistles, lots of square footage, things like that, which are lovely but expensive, and not something that the average person or even the person making an above average income can afford these days. So again, I always tell people there's mortgage calculators on every property website, Zillow, Zolo, wherever you want to look. And if you look at the mortgage calculator, even if your home is paid for and you're thinking, I'm going to sell it for X, and then you put that price in and look at what a person who doesn't have an all cash buyer, who just has to do it with a down payment and a mortgage, just have a look at what the monthly payments would be at the price points that you have in mind or that you're thinking you're going to list it for. And the fact of the matter is that a tiny fraction of the population can afford that. And many of the ones that can afford it are looking to downsize themselves, right? So this is why it's a shrinking pool of buyers, at least at these price points.
Yeah, and so that's a key point. And sorry, you're getting to the other thing I wanted to ask you, which is, if I heard you correctly, something I've been saying for a long time is, the homeowners we're all trying to hold together in solidarity, right? Housing's priced at the margin, right? So it's sort of like, look, if we just all hang in there and we don't sell,
Yeah.
there was this mantra of survive till 25, at least here in the States. And by 2025, the Fed should have brought rates down and the mortgages will be back down. We'll all be okay, right? And they're realizing now, okay, that didn't happen.
Yes.
So at some point, if you're a potential seller, there's a first mover advantage, right? You get out before everybody starts listing and then the price gets chased down. So I think I heard you say that folks were hanging in there carrying the properties, but now it's just getting more and more expensive, and they're not seeing the cavalry start to arrive anytime soon. And so, are you starting to see this market at the precipice of going from a frozen market to the first movers bolting first to try to lock in the best price they can, and then all of a sudden that's more inventory and the thing starts just de-thawing, but with price declines from there?
So there's two cohorts that really have an impact there. One is we're seeing a lot of people cancel their listings. So this would be the people that financially can afford to wait a little longer, maybe older, maybe paid off, and they're just annoyed that they can't sell their house for what their buddy got, 2 years ago down the street.
2 years ago, yeah.
Right? And so they're just saying, well, to hell with this. We're not going to sell. We're going to hold off and we'll list again in the spring. But they're on a vanishing runway in the sense of they're not getting younger, they're getting older. And this house isn't going to suit them anymore in the spring than it suits them now. And they still, this theme of wanting to downsize and consolidate their overhead is going to continue whether or not prices cooperate from their perspective. So you hear a lot of agents now, real estate agents, complaining that people are unrealistic. A lot of people are digging in their heels and they don't want to list at these prices. So the cancellation rate is very huge in Canada, but also in the US, I've noticed that. So that's the one cohort. Then the other cohort is the people who are highly levered or can't afford to wait, and relist later. So they're increasingly, there's a good rise in foreclosures happening through the court system. That's been going on for the past couple of years, but it's gradually increasing month over month. So there's a good amount of foreclosures now happening, and people are just like basically losing the properties. And so when that happens and you get a sort of a surge in that, you tend to get more forced selling and a ratcheting down of prices where market forces finally come in. So that's definitely evident, and I think that that will pick up as more and more people either, we're just into the rising unemployment now, Adam, as you know, and that is going to, by the Bank of Canada's own measures, the Canadian economy barely expanded in the first half of 25, 0.4% annualized rate of expansion in the economy, and we have a lot of red flags and concerns that the next year is not going to be a lot better. And that typically, even if the Bank of Canada goes back to cutting rates, which is expected now, unemployment typically rises throughout the cutting cycle when they're chasing the economy down. And I think that's the scenario that we're facing right now. And the other point I like to make is that we've seen this movie before. We saw the Japanese housing bubble happen into the early 80s. We saw the Chinese bubble happen after the GFC, right? Because the government there decided that the thing to do was help housing. And so they really threw all the stimulus into government financing and, ultra low interest rates to get the public to buy into the property market. Well, that bubble burst there, and property sales have now been falling for 5 years. So they're about 2 or 3 years ahead of Canada in this cycle. And there was cross-contamination there because there was a lot of Chinese money, just like there was Japanese money in the early 80s that was, looking for homes around the world and had bought up real estate. So there was a buying pressure there that was very prevalent in Canadian markets. From the Chinese inflows into the 2021 cycle. And then the government brought in foreign buyers taxes and things again, because the public was complaining, and rightly so. They're saying there's all these properties being bought up by foreigners. They're sitting empty in many cases, and we can't afford to buy because they've bid up the price. So it was a legitimate problem, and policy response always comes after the fact, and then they sort of excluded, or tried to limit the amount of foreign buyers, and that is good but painful, right? Because it's now even evaporated more of the demand picture. But again, back to the length of these things taking many years, not a couple. So again, China's done everything it can to keep stimulating and trying to reignite appetite in the public for buying and speculating in real estate, to no avail. And major developers that were, the star turns of the property cycle have now been going bankrupt, getting delisted. So there's this contagion as well in terms of the stock market that happens from some of these trends. So China's property investment, again, it's been dropping. So this portion of, your real estate investment as a percentage of GDP, which I highlighted as a problem in Canada being driven too much of, it's been falling in China consistently. And that's, again, something that's a headwind for the economy, just as it was a boost to the economy during the bubble phase. So that is one of the major deflationary aspects, that real estate deflation. It's such a huge impact that it's very hard to offset. And you put on top of that, just like we have here, aging demographics and now low immigration, which they've had in China throughout. But basically that creates this deflationary impact, and it's affecting all major sectors, which is being exported globally. So again, back to the fears about tariffs being inflationary, and I understand that certainly in some ways they're a price shift, and we aren't sure, to what degree that's going to be stair-stepped and continue as more items, inventories get drawn down, and the picture keeps changing month to month. So yes, there's some inflationary concerns around the tariffs, but this major deflationary impact, I think, is still the bigger story. And that's certainly what we're seeing in the Chinese market. And there, again, Treasury yields have fallen, 10-year China Treasuries at 1.77, as their GDP has, their debt to GDP has doubled. They're about 300% or something debt to GDP right now, a double from 08, and yet their yields continue to fall, which is, again, incongruent. Many people think, well, if the government debt goes up, yields are going to definitely rise. It's not what we saw in the Japanese experience, and it's not what we've seen in the Chinese experience so far. So it just gives us some food for thought.
Is
Um,
China buying their own debt hand over fist the way that Japan has?
yeah, so the Chinese banks and financial institutions are the primary holder of Chinese government debt.
Okay.
In Japan, I think originally it was more to the actual individuals were the biggest cohort of holding government debt. In China, they never got to that level of household wealth on a median basis. So they haven't had as much savings or ability to step in and buy the government treasuries as an investment or as a store of value.
Okay.
So the other thing is, this business about this is also disinflationary or potentially deflationary. Oil, again, peaked on the whole China reflation story in 2011. And then again in 2022, when the negative rates were driving all this mindless consumption around the world. And it's been rolling over since. So our long-term target has been $40 a barrel. And we got there in the 2008 downturn. Of course, we got there way below there in the 2020 pandemic in the original shock. But I think that the IEA also sees output growing faster than demand over the next couple of years at least. And I think that could help in terms of a disinflationary or potentially deflationary force as well. So that's another factor to keep in mind. And when we look at the CRB index, even though precious metals, which make up 7% of this basket, are, as you know, at all-time highs, have really exploded in the last little while, the CRB basket has not made new highs. It's just kind of flat and hasn't had any inflationary revival, so to speak, since 2022. So again, that makes me wonder if, under the financialization that's gone on in the economy, the real economy, is still stagnant, is stuck. And I think that is something that has to be remedied by lower prices across the board. The other thing, as I think I touched on this, Eric Bagmasian does some great work in terms of the construction being a cyclical factor leading employment in the economy. And this is just reminding that the worst unemployment cycles happened in the 1980 and 1990 housing-led recession. So Canadian unemployment has come up significantly from the June 2022 low. But I think that, again, this suggests that that tends to continue for a period of several years during these type of correction environments. And of course, we've seen the same kind of stuff happening with really weak, as these crazy revisions come in from the BLS, et cetera, you've got this really negative trend in payroll growth in America as well. And that's something we've only seen during past recessions. So just, again, a question mark. If the labor market is continuing to deteriorate, is that not going to force more people to try and consolidate households, sell property, raise cash,
Tighten their belts, yeah, reduce
tighten their
spending.
belts,
Yeah.
tighten their belts. And we're certainly seeing that from major retailers, Macy's notwithstanding, which apparently blew the doors out, but good for them. Everyone else is sort of saying the consumer is getting very frugal.
So, hey, real quick, just as you were talking here, a headline came across Yahoo Finance titled "Jobless Americans Outnumber Openings for the First Time in Years," which is a really interesting. I haven't had a chance to actually read the report yet, but for years and years now, we've had the chair of the Federal Reserve talk about how, hey, we've got way too many job openings versus the people that we need to fill them, and that was a big part of not only bringing the CPI down from 9%, but hey, I need to cool this labor market, right? So that's a very different story than we've been being told for the past bunch of years, or it's a big milestone. Secondly, your chart you had back there of the Canadian unemployment rate. I wish it had the recessions shaded in it, because I know what the US one looks like, and essentially almost without fail in this data series, what happens is once the unemployment rate bottoms and it starts coming up again, it then tends to spike hard into the next recession. And we're seeing here, okay, Canadian unemployment has bottomed and is starting to rise pretty dramatically. What would keep this from spiking into another recession here? Like something would have to be quite different this time than in all the previous cycles.
Well, actually, the truth is that it spikes through recessions and into the recovery. So even after central banks have finished cutting rates and the economy has bottomed, unemployment traditionally continues to rise for a
Right.
period of time. So it's not, businesses are not quick to bring people back. They always try and be more efficient at the outset. Another major factor that's happening right now is that our governments are, there was the major hiring that went on during the pandemic was from all levels of government. That was the major source of employment. A lot of that happened in America too, right? And what you're seeing now is that there's a move afoot to cut government spending. And also one of the sort of low-key ways to do that is to tell people that have been working from home for, which was again part of the factor that drove all of the exodus out of the urban centers into cottage country and ski country and all these places buying up these properties, was this notion that they could work from home and that they wouldn't have to be at the office. And now it was the federal government, the provincial governments are now increasing. The major banks just increased a mandate that people have to work fully now in the office starting this fall. And so, the unions are all up in arms, everyone's angry, but this really speaks to a loosening labor market where employers are now back in charge and saying, like, if you don't want to come, then quit. Like, we don't really care. We've got enough workers and we're looking to downsize
Right. And they
anyway.
would much rather you quit than fire you because they don't have to pay you severance.
Exactly right. So that factor is also weighing on. But as you rightly point out, I think that even if the downturn ended today, the fact is the unemployment rate is likely to continue rising, and that typically is what happens. So I could have put, as you know, 20 charts on credit, but this is
Yeah.
just one that happened to come recently. But the credit card delinquencies, student loan delinquencies, mortgage delinquencies, the insolvencies and trustee are booming up here. And I follow several of them, and they are just like, they can hardly see people fast enough. And they're reporting that for a long time, it was just people that didn't own houses that were in there because the people that owned houses were able to refi. And now it's across the board. It's people with household incomes more than 150,000 a year. It's, people with properties. And this is where the really crazy stuff starts to come out in the open, because they're reporting things like, people had three, pre-construction condos they'd bought by a line of credit on something else. And, they only put minimum down. And now those things are coming up and they can't get the appraisals to justify getting financing, and they're getting sued. And like, the lawyers are getting busy, right? This is again, a boom time for the undertakers, so to speak. And it's just a natural part of the credit cycle.
A boom
Um,
time for the undertaker. What a great turn of
it's
phrase.
not, it's grim, but it's true. I had insolvency and trustee told me in 2007 that he said, well, you see, Danielle, we are the undertakers. And I thought, oh, that's so true.
Hmm.
So anyway, the Canadians are spending less. This is just, sadly, the average person doesn't understand these cycles and is sort of sucked in from one mania to the next. They couldn't buy housing fast enough when prices were at all-time highs and mortgage rates were less than 2. And then they have recently, turned trail, and now they can't get enough US stocks. Even though US stocks in Canadian dollar terms have not done well, haven't done great year to date, but they're just like in a frenzy about the AI, and they're following the social media news, and they can't get in fast enough. So it just shows that they're now trying to buy up US stocks. And as you know, record valuations, whether it's the S&P book value at 5 times, or price to book at 5 times, or price to sales at 3 times, or CAPE at 40. I mean, any measure you take, market cap to GDP is more than 212%. It's just ludicrous fringe. 29, 65, the year I was born, there we were. That was a peak. 99, the year my son was born. I always tell him, you were born at the peak of a mania, son. And now we have it again today. So that's
So, Danielle, this feels very much like the person who is having money troubles saying, all right, well, let me go into the casino and see if I can't make it all back at the craps table.
This is so true. This has been the gamification of our financial system since 2008, when the crooks weren't carried off in cuffs. We let everyone away with everything. There's been this huge magnification of all the traits that were crazy then have got even worse. You have a president that is making billions on crypto. It's as if, conflicts of interest, we used to at least put a sort of a hat tip to the fact that they weren't good in policymakers and we should try and have a bit of division. But nowadays, conflicts of interest are just rampant, and people seem to think, well, if everyone else is getting away with this or everyone else is doing crazy, I might as well do crazy too. And I really do think that that's been the sort of contagion in the public consciousness. Certainly in young people, they've thought, okay, boomer, I'll never get a house. And I keep telling them, you will get a house, but you have to wait for prices to come down significantly. And the trends suggest that that could very well happen. So it's not like an impossible thing, but people have sort of decided it's impossible. And so there's no hope. And so I'll just gamble and see if I win. That's basically what I've noticed a lot of people have been speaking like. They're levered up. This is just margin balances again. And this is, both from short selling, but also from levered long. Very little cash or treasuries in any of the professional funds or any of the actual portfolios. As stocks have leapt in the last year or since April, there's been no rebalancing. In fact, again, the finance sector loves to bring products out right at the peak of everything. And
Right.
so now they're doing these levered ETF products, right? And the public is pounding it. They're thinking, well, if the S&P went up 25% and I buy this, it'll go up 50%, so they're just, they're making off like bandits as usual. The product salespeople make the fortunes. So that's more evidence of that. And you've just got, again, this whole, the most high equity exposure since the peak of the 2007 bubble. And it just, I always try and tell people, you're 24 years older now than you were then. And or than you were in 2000 when the tech bubble burst the last time. It's almost like we've taken 2000 and 2007 and squished it together here in a horror, what do you call it? Play of horribles, because we've got a tech bubble from like we had in 2000, but at least the real estate market wasn't in a big bubble in 2000. It had been coming down. And here we've got the real estate bubble and the tech bubble at the same time. After years of zero interest rates. So I just think that the financial risk has never been higher, just as people have never been older in terms of, the bulk of the owners of the equity market and of anything on that in the financial product sector tends to be the over 60 crowd. And, I see things, and I've talked to people, they send me their portfolios, they're 70 years old, they're 85 to 90% in equities, and maybe they have 10% in some high yield debt or a high yield debt fund. And, you try and say to them, this is insane. And they go, well, my advisor thinks it's fine and we've done great. It's like, yeah, you've done great in recent times, but what if we're into this correction phase that could take prices down significantly from here? And they kind of look at you with glazed eyes. So
yeah. So two things real quick. One, it's parade of horribles, which I think is a great way to describe this.
Thank you.
And the analogy to that person you just talked about, it's like the guy that jumps off the 20-story building, and as he falls, past the 10-story, someone says, how you doing? He says, fine so far, right?
I know. And it doesn't seem as fun to be worried about what can go wrong, but it's just, I've been doing this like more than 3 decades now, and I've seen this before, and it's not a small thing. It's a big impact. And unless you can go back to work and put the hammer down and keep saving for another 10 or 15 years, a conservative equity allocation for someone over 70 would be like 20%.
Right.
If you want to be in the market, that's the kind of thing. But routinely people are 60, 70, 80% in equities today. And a lot of that is they didn't want to rebalance because prices went up and the the meme becomes, well, I don't want to sell anything because then I'll have to pay tax.
Yeah.
And that's where you get really locked into things. And I always say the downturn takes away your tax problem. Don't worry about it, you know.
That's a good way to say it. You know, that chart you had showing that we're at very high levels of equity exposure. I've seen a version of that chart broken out by age cohort. And the
Yeah.
cohort that has the highest degree of equity exposure is the older cohort, right? The ones
Yes.
that should have the lowest, right? Yeah.
Yes, I saw a stat that the over 60 owns 79% of the housing equity, and I think it was 72% of the stock market equity. So, you know, Danielle DiMartino Booth has made this point in the past that when they start cutting interest rates on GICs, CDIs, to the extent that anyone has money in interest-bearing instruments, as we know, there's a higher propensity to spend that. And so if that starts to go down, her concern is that may be a catalyst for more selling on the risk side. It certainly should be. There should be some catalyst coming here. Unfortunately, most people just wait till it's tanking, and then they call their advisor and start freaking out and saying, you know, get me out, get me out, get me out. And then it's very tough for the advisor because, you know, they're trying to keep them in the seat. And that's usually not very successful when people start to panic. So Treasury prices, you know, again, I'm mindful of that chart of China and how these disinflationary forces have continued to push Treasury yields down. Now, we knew we had a big sell-off in Treasury prices into the 22, you know, we had a huge bear market in government bond prices, well, bond prices and dividend proxies. And that seems to have stabilized. So we're seeing, you know, certainly Canadian Treasury prices are up 11% now since the March 2022 bottom, and that's on the on top of the coupon. So, you know, we'll see if that continues, then yields will continue to fall if Treasury prices continue to rise. And by the way, all this talk about the foreigners abandoning Treasuries, I don't see that in the data. I see the TIX data. You still have foreign appetite coming in. You still got a significant flow there. And you know, this is John Hussman's chart, but I always like to check in every once in a while and see where we're at. And he's just saying, you know, of all these price periods in time, that little dot on the left is where we were in July, in the sense of we've never seen equities having prospectively more negative returns relative to treasuries over the next 12 years as we do today. And even the sell side shops like Vanguard, Goldman Sachs, Morgan Stanley have recently come out saying, yeah, actually treasuries are likely to outperform equities from current levels, which is a no-brainer. I mean, because once we know that, you know, 75% of future returns come from what you're buying at, like the valuation level. And if I have some, I would say, encouragement to my concern from here with respect to equities, it is of the experience of the property market. How in 2022 and 2021, I was writing and speaking about it every week. Guys, this is crazy. This makes no sense. Look at the math. It doesn't math, you know, all that. And people thought I was just ridiculous. And of course, now they're starting to say, oh, what's going on? Like, why are prices not going up? So I think that that kind of thinking is still yet to come with respect to the equity market. And so we have an opportunity here, as I'm trying to say to people, to pay some tax notwithstanding. If you've got some capital gains, move some money over, you know, take advantage of locking in interest bearing north of 4 in America. It's still around 3 in Canada. You know, there's a reason to hold these things. And this just goes on to show that, you know, the TSX, some people speak about Canada as being a value index, and that we will fare better because we are relatively less undervalued than the US S&P 500. We have one tech company, Shopify essentially, and we've not had the same mania. But the problem is we're trading about the same valuations today as we were at the peak of the last cycles. And all of the gains, this goes back to if you buy or hold when things are high, it took 12 years for the TSX to break even. Like from the 2008 peak, It didn't durably surpass that until 2021. So that means that all of the gains from, in terms of capital gain from the TSX, have happened just since January of, just since 2021. And that it wouldn't take a lot to get back to, you know, what the price was many years ago. I mean, a 25% correction would be extremely weak and little in this kind of environment from these kind of levels. And that would take you all the way back to where you were almost 6 years ago. And, you know, it would just take 46% to get back to where we were at the peak of the '08 cycle. And people think that's impossible, but actually that's kind of typical. And this is just, you know, Ned Davis research reminding people that complies with historic record, which is it takes about 76% of the time to make back your losses in the stock market. If you hold at these peak levels, the things correct, and then it spends, you know, many years trying to recover those losses, and you only get the gains in a very short period of time. So I know people have fear of missing out, and they don't want to be out in case they miss those gains, and fair enough, but the problem is that if you don't have any discipline around when you're culling or reducing or pulling back your risk, then you're just sort of riding it up, crashing, taking years to ride back up again, and all that sort of thing. And you're really getting nowhere. And as I've said, you're not getting younger. None of us are. And of course, now there's this stuff about, oh, the Fed, you know, the Fed's running to the rescue. They're going to start the cut rate, the rate cutting cycle. It's going to solve everything. Well, we had, you know, the 50 beep cut in September of '07, and then we had them, you know, on pause. They paused for 5 months, kind of similar. We've had a big pause since December here. And then they chased the economy all the way down into 2008, right? Slashing to zero and leaving it there for 7 years. It still didn't revive the stock market. So it's important to keep that in mind. It's not as simple as they just need to cut rates and that fixes everything, although that's what many people say. You read that on social media, you read it on X every day. They have these charts showing from the first Fed cut how the stock market always rallies, and they conveniently leave out the periods where there was an economic downturn as well, never mind a real estate driven economic downturn. And in those scenarios, you typically saw the stock market have as they were easing. So again,
right. Kind of back to my pattern on the unemployment rate. The pattern on rate cuts is you know, usually it's when the Fed starts cutting rate is when the wheels come off. That's when the economy slumps. That's when the Fed starts panic cutting, trying to catch up. Yeah, so you know, I don't know why people have this narrative that cutting is always equals higher prices, because we always see at these cycle turns, it's usually the Fed showing that it's arriving to the party too late, and you know, you have that big correction.
In light of my earlier comments, I'd just like to point out the far right half of this chart here, which shows that 89, 90, 81, 82, 2001, 02, 07, 09, those were real estate-led downturns, 3 of them, and tech-led downturn for 01, 02. And those were the longest bear markets where things did not revive just because the Fed was cutting. And those are the factors that are confronting us today. And again, you know, it's a fallacy to believe that you can hide out in dividend-paying stocks. They may decline less than tech stocks. Hopefully they will, because tech stocks, you know, often decline by 80% in this environment. Mm-hmm. So hopefully dividend-paying stuff will be more cushioned, but it's certainly not cash-like. Right? And this is again something that people sort of mistake. They think, well, I've shifted into safer dividend paying, and it's like, well, not if we get into a real bear market, because everything basically gets sold in that environment. So that's something to keep in mind. And I just wanted to point out, I've said before, I'm very agnostic on bullion, and if people like bullion, I'm all for it. If you want to hold some of that as a store of value, you know, whatever hedge you feel most comfortable with. I would point out that we've seen this massive financialization, not just of crypto, but in the precious metal space as well. So, you know, you've got this endless stream of products back in '08, there was one Bitcoin, and now there's hundreds of thousands of crypto things that people are buying and putting, speculating with, et cetera. And there's all kinds of ETFs and funds that have come out in the precious metal space. That makes me nervous because they've all sort of been trading together. In other words, they sold off together early in the March 20 downturn. They rallied together. They sold off again in the 2022 bear market, and they've rallied again in the last little while. So all I'm saying is I'm a little worried that financialization has sort of muted or dampened any diversification benefit. And so I just caution people that we're going to have to test this by seeing the next durable downturn, how these things perform. And I'm quite sure, I feel pretty confident that crypto is going to trade down with all the other risk stuff. And it's going to be interesting to see to what extent the precious metal cohort is able to hold up. And it's always kind of the same reason. The longer it goes up, the more it's attracted in people that are not so convicted of its long-term hold, and they're more trying to speculate, and the less patient they tend to be if there's any kind of price decline. So I just
they get shaken loose.
yeah, and I think that's we'll see that tested in the next little bit. And I just like this quote from Warren Buffett because I think it speaks to everything. So many people that have got and amassed a good deal, the bulk of their life savings, could live very comfortably if they just didn't spend crazy, didn't speculate crazy, basically collected decent interest income and, had a nice life. But instead, they're taking what they have and need for that purpose and plunking it into very risky plays. And I think that is the very problem with all the asset markets today. The people owning them are overexposed with shorter time horizons because of their age. And I think that is likely to magnify things as we get into a downturn.
All right, Danielle, it's been a fantastic presentation. I'm just going to read this for the people that might be listening on a podcast and don't have the visuals in front of them. It's a quote from Warren Buffett. It says, "Don't risk what you have and need for what you don't have and don't need," right? Just very simple common sense, but as Danielle has, just walked us through, the vast majority seem to be doing the inverse of that right now. All right, Danielle, so fantastic. Let me just ask you this to kind of get to the so what, which I always like to try to conclude these conversations on. So with an environment like this, it's clear that you are, big on de-risking right now, and a way to do that is to reduce your equity exposure. At a minimum, maybe make it age appropriate, but probably have it be more conservative than that for all the reasons you mentioned here. Sounds, if I heard you right, it sounds like you're saying, hey, in the near term, T-billing and chilling is not a bad thing to do. And if we get some sort of corrective event in the markets, you're going to be real happy just sitting there in safety, earning your 4% or whatever it is, even if the Fed starts cutting. 2% is way better than down 80% in a tech stock, right? Beyond that, are there any strategies or asset classes that you favor right now, given where we are in the current story?
Well, for my concern with respect to positive correlations that have developed across the fold, the only ones that I see any potential for holding up if the selling accelerates here are potentially, as I say, Treasury bonds, which it's not just T-bills. You can lock in 3 or 4 or 5 years here and have yields over 4%, which they are also very liquid. It's not like, a guaranteed deposit where you're fixed. You don't have to hold it for 4 or 5 years.
You can sell it right now, yeah.
Right? So I like that kind of a prospect. And, a few years ago, the risk-averse options were paying next to nothing. These are paying more than inflation. I'm quite happy with that. The US dollar has been oversold here for Canadians. I think maybe that could be a potential safe haven and potential capital gains. It typically is during big bear market sell-offs. But only if you're in cash or cash equivalents, not if you're in equities, US equities, right? So it's very tricky. I think that the big themes are look at your income statement, look at what you're spending, look at how much of it is in risk assets, consider how that would impact you if they were to have a multi-year decline. If you have a lot of real estate that you're looking to offload, maybe be pragmatic in terms of the big picture, looking at price trends and how they're not likely to improve in the near term. And maybe, get your house in order rather than hang on what you think something should have sold for a couple of years ago.
All right. Danielle, just a fantastic discussion. You totally delivered today. I know folks are A, going to love this, and B, say, hey, Adam, get her on again much sooner next time. So hope we get a chance to do that. Just in wrapping up here, I don't want to put words in your mouth, so correct me if this is incorrect, but I kind of get the sense from you that you feel like this may be a bad analogy, but like, a mountain with a high avalanche risk that like you don't know which snowstorm is going to cause the avalanche, but just over time with enough snowflakes hit, one of them is going to be that critical instigator, and then the whole thing happens. So it sounds to me like, hey, timing wise, we don't really know when this multi-year correction is going to happen. We don't even know what the trigger is going to be. Just the weight of all the things that you talked about are going to continue to weigh on this thing until some trigger proves to be the one that's that last snowflake that just starts it all. And so better to, get to safety sooner rather than after. And so, that's why you would recommend people de-risk in the way that you just mentioned here, correct?
Yeah, because human life is full of risk every day in every way. And it gets worse as you get older in the sense of the finite nature of your lifespan. So I just think you should be eyes wide open about that. It doesn't have to be a sad thing, but it should be something that you account for in your plans and decisions.
All right. I think the only other thing I would add to that, to use an American analogy here, but like if you've had a really good run, right? So, if your portfolio is doing well and you own a couple of different houses and all that type of stuff, right? Like don't put yourself in a position to fumble the ball on the 5 yard line. Like you're almost in the end zone of life. Like don't take dumb risks and ruin it all, right when you're so close to the finish line. Agreed?
Exactly. Yeah, absolutely.
All right, Danielle, and now the most important question for folks that would like to follow you and your work in between now and the next time you appear on this channel, where should they go?
My firm is venablepark.com and my daily blog is jugglingdynamite.com.
All right, fantastic. And Danielle, when I edit this, I will put up the URLs to those there on the screen. And folks, I'll have the links down in the description below the video if you want to get there with just one click. Danielle, as always, just such a great job today. Really look forward to having you back on the channel soon.
My pleasure, Adam. Thank you.
All right, well, now's the time on the channel we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money, to both share their key top takeaways from the interview we just did with Danielle, but also give us an update on what the market's been up to over the past week. I'm joined as usual by lead partners John Lodra and Mike Preston. Hey guys, great to see you here. Great conversation with Danielle. Lots going on in the markets, especially with the precious metals. So lots to talk about, but John, why don't we start with you? What's your key reaction to Danielle's, I think, quite excellent presentation there?
Hi, Adam. Great to be with you. Yes, excellent presentation. I would totally agree with that. And we got to credit your program, Adam, for introducing us to Danielle. We weren't familiar with her work until a few years ago, I think, when you first had her on. Maybe it was further back than that. But we really, really appreciate her perspectives and the data that she brings to it. I mean, she went through a chart pack there that's undeniably paints a picture that is pretty stark, and it doesn't matter till it matters. We had the good opportunity to chat with her briefly off camera after you recorded with her, and we're I guess kindred souls in the sense that we have often said, and she said to us that sometimes it would be just so much easier being a bull, but when you look at this data, you can't just put your blinders on, and it doesn't matter till it matters. And every bubble, which we are not at all bashful to use that term, as I think she has used in very stark terms, and if not cloaked terms, we're in a bubble, and it's a bubble that pervades many asset classes. Certainly, real estate, certainly the stock market. The bond market was in a massive bubble, arguably much less so now that the Fed has, come off the zero interest rate bound and the huge quantitative easing. But we're in rare times. You can look at all of history, and you can never find you can find no instance in history where we have had all these markets as richly valued together as they are now. And that's just black and white data. It's not subject to anybody's opinion. And the one thing we know from our careers, which is, I think Danielle said she's been doing this 30 years. We've been doing it nearly that long as professional advisors, and just as long, if you think about our interest. And we've seen this before. And every bubble ends the same way. It ends with the stages of disbelief and grief, and people getting sucked in at the late stages because of the seduction of this time is different because X, Y, or Z. What is it going to be this time? Is it going to be the mantra of liquidity, and markets can't go down with liquidity, central bank liquidity, or fiscal liquidity, whatever the case might be? We have little doubt that gravity will end up playing. So the broad takeaway is what we do is in our roles as advisors to real people, we boil it down to takeaway actions. And we couldn't agree more with Danielle that one key takeaway is this syndrome can last longer than even it has, but it still is not a good reason not to de-risk and scale back risk. And I've got some things later I want to talk about in terms of the real consequence of sequence of returns risk on a real person's hypothetical retirement. But we totally agree with the broad takeaway there. And I love the last quote she shared there that Warren Buffett was attributed to Warren Buffett. I don't remember it exactly, but basically it was to the effect of don't risk what you can't afford to lose in pursuit of those things you don't have nor need, right?
Yeah.
Many of our clients have built very sound financial footings, and even folks that still have work to do. The biggest risk in these kinds of markets is not missing out on the last gasp of a very richly overvalued market. It's in unwittingly suffering major declines that can wipe out years, if not decades, of progress.
Yeah, and this, we've talked about prospect theory in the past, but this is where as humans we experience the pain of a loss twice as much as we enjoy the joy of a gain. The problem is most of us don't really realize that, and then it just all goes out the window when FOMO is running hard, right? And in markets like this one, bubble to use your words, John, FOMO is running really hard, and everybody is trying to figure out how do I not get left behind here, right? And the sad probability here is that if this does indeed turn and correct the way that highly richly overvalued markets like we might be in now do, it's not just going to be, I got the inconvenience of some losses. For a lot of people, especially the older people who have the majority of the wealth, they may find themselves set back, John, not years, but potentially decades, right? In some of the worst situations.
Yeah, absolutely. And I'll just share a couple of charts here, Adam. And one thing I want to make clear is when we say de-risk, it doesn't mean go under a rock, doesn't mean put cash under your mattress, maybe a little bit, but not all of it. We still have at this moment about 45% equity exposure, and we're picking our points very carefully within the equity market. We have exposure to sectors that our systematic relative strength tools have guided us into that have been, by and large, the outperformance this year, for example, and have avoided areas that have been laggards. So it's important to right size and de-risk your equity exposure, but also with what exposure you do have, be in the right areas. And I use right in kind of air quotes. It's not a perfect science. It's a matter of using systematic tools and rules to kind of guide you in the right direction. But also bringing tools to the table like hedging tools. We oftentimes talk about hedging on your program, Adam, and this is a way of having an asset, having exposure, but taking the sting out of an unfortunate outcome out of the equation by using hedging tools. We use options to hedge risk, covered call options, protective puts, and combinations like that. Those are very aptly applied tools in the kind of environment we're in right now. I just wanted to kind of bring it back home before we pause on it. And Mike has got plenty to say, I'm sure, here. But let me share, and I've shared this with you before, but I hope this isn't redundant. I think it is hopefully illustrative as to what's at stake here. This is a little hypothetical example I put together, just showing the consequence of retiring at a bad time, an unlucky time, and what we call sequence of returns risk. And this shows a hypothetical example of a nest egg, starting nest egg of $1 million. And this particular couple person needs to generate basically 5% withdrawal rate per year and give themselves a raise 2.5% each year for inflation over their retirement period. This is you can see a typical retirement period. If, for example, and what I want to show here is the actual sequence of returns from 1973 through 1977, 1997, which culminated in ultimately the tech bubble peak, but started with the nasty 73, 74 bear market. And you can see the average, simple average return was 10.1% over that time frame. But in this scenario, if you do the simple math, starting value, gain, loss, and then ending value, this couple, this person ran out of money before their retirement period was done. Now, if you take the same sequence of returns and reverse them, so the 31% happens in the first year versus the last year, and the bad, back-to-back negative years happen late in life, dramatically different outcomes. Still, the average is the same, but look what happens to the leftover ending value. So the cost, the difference between here and here, we're talking about millions of dollars simply
That's
by
amazing.
when you retired, or more correctly, it's not a matter of like, should you retire or not? This is all about making sure you're positioned properly. That's one thing you can control. We can't control, none of us, what the markets are primed to do or don't do, but we can absolutely control how we invest in response to that. And that's something that mainstream Wall Street will never tell you. They'll say, always stay invested, because if you miss the 10 best days, you're going to be forever harmed. That is a self-serving cliche that is tired and overused. Even Vanguard, as Danielle talked about, has preached caution. Right now, they're predicting 10-year returns for Treasury bonds to outpace U.S. stocks with far less volatility. Now, that's not a slam the table, buy, load up on 100% Treasury bonds. But if you're going to buy and hold something for the next 10 years, which is what Wall Street mostly tells you to do, be very, very careful about where the stock market is.
All right. All right, heading over to you here, Mike, just two quick things. So, John, the key thing to underscore here is, at the end of the day, folks, we watch channels like this one. We talk to experts like Danielle because we want to make more informed decisions with our wealth. And while these conversations can be really intellectually engaging, at the end of the day, you got to remind yourself, well, what's it for, right? It's so that I can make sure that I am able to fund my life goals by the time I want to be able to fund them. And a really important part of that is not just picking, the most promising investments. It's just making sure that you don't do anything reckless with what you have, with the wealth that you have built up. This is sort of my analogy of fumbling the ball on the 5-yard line. So, key thing to keep in mind here is, there's lots of really interesting things going on, but at the end of the day, you really want to make sure that you've got a really good defense in addition to whatever offense you're building, because you don't want to put yourself in a position where you may not have enough time to make up to try to get your goal, try to hit your goals if some adverse event happens. All right, Mike, coming over to you real quick, John, just to give full credit. Thank you for recognizing this channel, introducing you to Danielle. I want to credit the source that put me in touch with Danielle, which was Jay Martin. He produces the Vancouver Resource Investment Conference, and I shared a stage with Danielle 2 years ago, I think. And that was the first time I ever met her. And she left such a big impression on me that I had to call her right afterwards and say, I need to get you on my channel. So I want to give props to Jay there. All right, Mike, look, I'll let you react any way you like above and beyond what John has done. But if you can, also speak to the price action that's going on in gold and silver, because things are getting really interesting there. We've had some major breakouts, and this is something that you've been predicting for a long time. So we'd love to get your latest thinking on it.
Sure, thank you, Adam. I could really sense the frustration a little bit in how Danielle is seeing and talking about these things. She's got a lot of data, and she shared a lot of data with us today. I love the charts. The truth is the data hasn't mattered. It hasn't mattered for so long now. really hasn't mattered much since the last great financial crisis. But that doesn't mean it's not going to matter. And we're here to say that the data does matter. This time it hasn't mattered longer than ever before. And nobody knows when the turn actually comes, but there are some early indications that Danielle talked about in terms of unemployment rate rising and credit card delinquencies at 12-year highs. I think she said that type of thing. These are early indications. If we had to guess, and sometimes I think we do have to guess, we think that the markets are likely to top here sometime in the next 6 months or so. We're starting to see some real speculative fever, and would not be surprised at all to see a little bit more of a vertical blow off top. That would be a signal that the end is at least getting closer. But these things are very difficult to time. They're very difficult to recognize when a market's topping. It's only after the fact, and then after the fact, nobody wants to sell, and so they're trapped. So we're here to, help people react ahead of time, to properly position, and to put hedges in place so that we don't have to actually know when the top or bottom of a market is. We can use options to take, some of the need to be precise off the table. A couple things that I circled in my notes that I'd like to mention here, in addition to what John mentioned, and then we'll get into gold and silver briefly. Interestingly, I did not know that the Canadian housing market was down 10% already. There's some places that we've been reading about and hearing about from clients that are actually down quite a bit, and maybe even more than that, like for instance, Austin, Texas, things like that. There's certainly been a top in the market, but not the type of, in the housing market, not the type of top or decline you'd expect to see after mortgage rates have basically doubled from 2021, both in Canada and in the United States. It's been really frustrating for people that want to get into the housing market. They've been told for more than 10 years, well, housing prices are up because mortgage rates are down at 2 or 3%, and interest rates on deposits are zero. Well, when those rates doubled, we hardly even budged, and we're just barely off a bubble peak. We think that housing prices could go down easily 30% across the board. Some of the charts that Danielle shared showed that we could see that type of correction. And just looking at my notes, basically a few years into the correction here, and she says, and I'm just based on her chart, there was a 39% correction between 2006 and 2012. And if history is to be any guide, we likely have at least 5 more years left in this correction. So I would say continue to be patient. We're continuing to say that to our clients. We don't think that you should necessarily game your primary home. You need a place to live, but if you are looking to increase your exposure or looking to buy your first home and you can afford to wait a little bit, it's probably a good time to wait a little bit, especially when it's 2 times as expensive to own versus rent based on the charts that Danielle showed. And the last thing I'd like to say about the charts, which I thought was really interesting, Danielle showed a chart showing the major market peaks, and they were in 1929, 1965, 1999, and 2025. Those are the 4 big peaks on that valuation chart. And she talked about how this is the highest ever, and that's confirmed by Hussman's data and a lot of other places as well. Those 4 major peaks are almost exactly 30 years apart. I thought it was roughly uncanny.
Sort of like
29,
its own kind of
65.
fourth turning, turnings.
Yes, and it coincides with what we think about the fourth turning here, probably in the last 3 to 5 years of a fourth turning here. So we are probably at or near some type of peak. And when this peak is actually set, it could be the peak for the next several decades. So be careful, because the average person out there in retirement has 70, 80, 90% exposure to stocks. We see it all the time, not with our clients, but people that we review statements for. So when that turn happens, it's going to be hard to change later. So think about changing now. So those are just the things I wanted to mention there as part of her speech, her talk, that I thought was fantastic. And in terms of gold and silver, if you're ready for that, I'd like to talk about that a little bit too.
Yeah, so if you can maybe just pull up the chart, show folks where we are right now. We're recording midday on Wednesday, September 3rd. So say whatever you want to say, Mike. One of my questions for you is, at what point in terms of the price action will you guys start, altering how you hold your precious metal position? Meaning, when will you start taking gains off the table? When might you put on some downside hedges to, try to lock in some of these gains? So if you can include that however you can in your answer, that'd be great.
Sure, we've seen a big move in precious metals and in the miners. And for many months, the mining stocks have been outperforming the metal. And therefore, we're more tilted toward the mining stocks. And within the bullion metal itself, silver has been outperforming gold. And therefore, we're in silver right now. I want to just share a quick chart, a number of quick charts, actually.
Sure.
The
And as you
first
pull them
one.
up, not to pat ourselves in the back too hard, but this is what we've been talking a lot about. And Mike, you've definitely been beating the drum about, the upside potential you were seeing in the charts of where this could go, and that is indeed where things have been going, and it is largely following the script that we told folks we thought it would, which was gold would move first, then the miners would probably move after, and then silver would move last, but each successive asset would move further and faster than the one before.
Yes, that's what's been happening. That's what's been happening so far, and we'll describe a little bit of that here. This chart shows a 5-year chart of the gold-silver ratio, and it's presently at 86 or so. Longer term, over 5 years, that I think that average would if I were to draw a line here, it would be somewhere around maybe low 70s. So the ratio is still a little bit elevated and favors a more of a reversion down to the 70 level or so, which would favor silver. Look what happened just a little while ago, a few months ago. We hit 106 on that gold silver ratio, and we talked about that on this program. And it since has pulled back to that midline, mid 80s. And so that's been a good move in favor of silver. Let me show you the actual chart of silver on a daily chart here. So there's a triangle back here that I drew back in July. We were talking about that here, Adam, weekly. We were looking for a breakout. We had a breakout back here a week or two ago. It came back. It looked like maybe a false breakout, but then boom, the last 4 days, it's just really broken out. And so if you take, from a technical analysis standpoint, if you take the height of this triangle from top to bottom and then add it to this breakout level, it brings you up to around this line here, 38 on SLV. That would be a first target, and that's around 42 or so on spot. Spot silver right now is 41, 41 and a half, and we've been thinking that the next level of resistance for silver is in that 40 to 42 level. And that's where we're at now. For people that feel like they're perhaps overexposed, that might have been heavily in silver and gold all along, we're telling them to sell into this rally a little bit at a time, even though we think we're likely going higher. I would not be surprised to see silver settle in the mid 40s or so and consolidate there. The old high was 50 or so back in 2011, but if I remember right, silver was only there for a couple days, so that hardly even counts. So it's almost like silver is really close to an all-time high here, even though not yet on a spot basis. But up at these levels, these have been some big moves, just pure technical analysis moves here. And and interestingly, if you take a look at where silver's gone since April, silver's been trending up since April, and it just accelerated here. If we take a look at gold, we were talking, I think, in the last few weeks about gold, that gold too had this triangle going back to April, but then just flatlined and fell asleep. Just went to bed. And we were saying, well, when gold breaks out, silver should accelerate, and that should push the miners even higher. Well, that happened in the last week. Gold is sitting at a new high. So there's no telling how far this can go. But now the miners, if you take a look at the miners, they've just been going crazy and hit what we thought were aggressive targets a few months ago. We're already there. Take a look at the junior miners on GDXJ. It went from 65 to 85 just a couple weeks.
Wow.
And lastly, GDX, which is in our portfolio. Whoops, I just typed in the wrong symbol. GDX went from 52 to 65 in just a few weeks. And so we just adjusted some hedges on GDX actually today. We have half of it written with short covered calls to bring in income because we know at some point we're going to have a pullback. We don't know if that pullback comes from higher or from here. Learned a long time ago to try to not call tops because things can go a lot further than you think. but we are getting extended from the 21-day moving average here in light green and from the 50-day moving average in red. So hard to give targets for these things, but I would wager that we go higher. But just remind people to sell a little bit into the move, particularly if you're starting to feel a little extended. But if I were to go to a monthly chart again on GDX, all these years, the gold bulls and mining bulls, all these triangles that we wrote about and talked about, we were early on many different occasions. But look at all this return. All this return came all at once. GDX has almost doubled this year, and could easily double again in the next year or two if gold continues upwards into what we think is likely to be the 4,000s or so. But don't get ahead of yourself. Don't forget to hedge and or take some profits here because now we're getting a little bit stretched.
All right, very well said. I'm just looking at the time. We're going to have to start wrapping it up here. But Mike, we will be, I'm sure, revisiting those charts in the next couple of weeks in particular, because either gold continues to run from here, and that's going to be, extremely interesting. And if there's a correction, obviously the big question is going to be, well, was this just a blow-off spike that we were just in? Or, a lot of times when you have a breakout like this, you then it falls to retest key support. And then if it bounces off support, that can oftentimes be a very bullish signal for what lies ahead.
Agree. And one thing I've learned in my career of 25 or over 25 years now is that when you have a market that's been basing out for a long, long time and it finally turns into a bull market, you'll often see a double off the lows and then another double after that. And so I was looking at some of the silver stocks this morning. A lot of them have doubled in the last couple of months. But if you look at the longer term charts, particularly if silver and or gold go higher, all of these things could double again. Now, those will probably take longer to double again, but that's what I've seen across the board, not just with mining stocks, but with other sectors and stocks in general. In a real bull market, it will double, and just when you think it's extended, it will likely double again with patience.
All right.
So,
But obviously, folks, no guarantees. So
obviously not.
yeah.
Take it slowly, keep your position size in check, talk to your advisor or us.
All right. And John, I'm going to hand the baton back to you right on that last point Mike just made of talk to your advisor. There's a lot going on here right now, right? There's a lot of money currently being made in the markets, certainly on the speculative side and on the, in Mag 7 and all that type of stuff. But also on, the safe haven side, it's traditionally been the precious metals role. So there's a lot to be excited about, but there's a lot to be concerned about, as Danielle, walked us through. So, I think a lot of people are saying, "Whoa, wait a minute! Like I've not really been in an environment like this before, and I want to first and foremost, don't want to put myself at risk at potentially losing a whole truckload if there is indeed a big correction like Danielle thinks might happen. But also, I don't want to just sit out this upside opportunity if there's upside potential there. So it's a really good time, I think, right now for most people to talk with a professional to both reevaluate their current portfolio allocation, revisit their financial goals, but then also have these sort of deep discussions around, hey, what makes the most sense for me right now, given the whole macro situation? So if you can talk to that need as we wrap up here, I think that'd be helpful for folks.
Yeah, absolutely. One thing Danielle talked a little bit about the job market and some noise we're starting to see there, not so positive noise. And I was just at my son got married this past weekend. It was such a joyous event.
Congratulations.
Thank you. But I was talking to a lot of folks at the wedding, and there were more than a few data points about people having lost their jobs or know people that have, and that could be a very, very traumatic experience for anybody, right? Especially ones that are later on in their career and aren't quite sure if they've reached the finish line yet, and it's not their choice, but it's been thrust upon them. One of the very first places I want to tell people to kind of think about is their 401k plans that are at their employer, because oftentimes those get forgotten about. Even if you're already working with a financial advisor, oftentimes those are the forgotten assets because they're just set and forget. But absolutely take a fresh look at those. We do that all the time for our clients, even if these are accounts we can't manage because it's important to make sure those sometimes large assets are positioned properly. I will say we're actually growing our team. We've got a couple job openings, and I hope we see a vibrant job market because we are certainly in the hunt for some good quality people to help deepen our bench. You know, we're in growth mode, and we always want to make sure we can give our clients full and comprehensive service. And the best way to do that in our line of work is making sure we have great people to be on our team. So if anybody's out there listening and you know somebody that's in our industry, or perhaps yourself, you know, and you feel like you're a good fit, we'd love to hear from you. Shamelessly plugging our openings. You know, it really is really important to kind of bring this back to your own situation. Forget about the keeping up with the neighbors or the headline news or whatever. You got to call your own top, so to speak, based upon where you are in your life. And the best way to do that is take a objective step back. And sometimes with the help of an advisor, you can do that more truthfully, perhaps, than within your own bubble, so to speak. But you know,
All right. Well, well said, John. And again, I'm going to murder this analogy here, or beat this horse to a bloody pulp. But like, you know, there's been markets have been very favorable to people for the past couple of years. Danielle has made an argument that party's going to end. And to your point about calling your own tops here, again, doesn't mean you have to all of a sudden go to 100% cash tomorrow, but you've got to determine when it is time to start leaving the party, especially if you think, you know, if I overstay here, I might be leaving in handcuffs after the cops arrive, right? So like, just to my football analogy, just don't put yourself in a position or minimize your potential for fumbling on the 5-yard line, you know, especially if you've had a good run and you're sitting on a lot of good assets right now. All right. Well, John, I'm glad you actually gave that plug for a couple of reasons. But first, I mean, it reflects very well on you and the New Harbor team that your company is doing so well, that you're in growth mode right now. And secondly, I do know that there are a lot of financial professionals that watch this show because they email me and interact with me on social media all the time. So folks, you know, if any of you are watching who, you know, if you know somebody, yeah, sure, recommend them. But if you're a financial professional right now that might be looking to join a quality shop, highly recommend you consider the guys at New Harbor. And if you want to hear my specific thoughts about them, if you're thinking about this from a job switch standpoint, feel free to reach out to me directly and I'll be happy to give you my direct thoughts on these guys. But the punchline is very positive, obviously. All right, well, look, in wrapping up here, gents, thank you. Let me just remind folks, first off, if you enjoyed having Danielle on and would like to have her come back on again sooner rather than later, please let us know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. You know, Danielle is based in Canada. I just interviewed Jonathan Wellham earlier today, who's Thoughtful Money's endorsed Canadian financial advisor. So if you're watching this video and you're thinking, yeah, maybe I might want to talk to one of Thoughtful Money's endorsed advisors, they're not just in the US like the guys here at New Harbor. We also have good presence in Canada through Jonathan's firm. So if you want to talk to an advisor and walk through a lot of the issues that we've been talking about here, work with a good professional financial advisor. I'm agnostic to whom you work with, just as long as they take into account all the stuff that Danielle and John and Mike and I have been talking about, and they're good. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't, or you'd like a second opinion from one who does meet that criteria, then consider scheduling a free consultation with one of the firms that Thoughtful Money endorses, maybe even John and Mike themselves and their team there at New Harbor. To schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. As a reminder, these consultations are totally free. There's no commitments involved to work with these firms. It's just a free service they offer to be as helpful to as many people as possible. Lastly, don't forget that we've got the Thoughtful Money Fall Online Conference coming up pretty quickly now. It's a little over a month away. It's going to be Saturday, October 18th. If you can't watch live, don't worry. Everybody who registers for the event will get a replay video of the entire event, all the presentations, all the Q&As afterwards. And if you haven't bought your ticket yet, you're still in luck because the lowest early bird price discount is still in effect. I want to make sure as many people get that lowest price as possible. So to lock it in, run, don't walk to thoughtfulmoney.com/conference. and buy that ticket. And as a reminder, if you are a premium subscriber to our Substack, look for the code I've emailed you. That discount code will give you an additional $50 off of the ticket price beyond that lowest early bird price discount I mentioned. Lastly, too, if you didn't hear the news, Lynn Alden just signed on for the faculty. So the faculty of this event just keeps getting better and better and better. All right, John and Mike, can't thank you enough, buddies. Another great week. Very exciting to see what's happening here in the precious metals, especially after you guys have been predicting that for so long. Regardless of what happens over the next week, I look forward to having you guys back on in a few days to make sense of it for us.
Thank you, Adam. Good to be here. See you next week.
Thank you, Adam. We'll see you next week.
All right, and everybody else, thanks so much for watching.
Most of it is leaving the COMEX, which is also very unusual. It's not going into the eligible category in the COMEX, it's leaving. So it's called a loadout. We're seeing massive deliveries and a lot leaving. Who's doing this? Same thing is true here in the West, where 40 plus central banks have pulled their gold out of the New York Federal Reserve, which would for 50 years give access to COMEX, and pulled their gold out of the Bank of England, which would give access to the LBMA. So they're taking physical possession, removing counterparty risk. So anyways, we see all this gold being delivered. Say several things that are provocative or certainly interesting, and that is he's a self-proclaimed gold bug. He said things such as, I want to remonetize the asset side of the balance sheet for the U.S. government. Now, he backed off saying it's not gold, but I'm thinking he's going to remonetize gold.
Physical gold deliveries have increased significantly, according to recent COMEX statistics, with warehouse stockpiles dropping from 45.1 million ounces in early April 2025 to 43.6 million ounces by mid-April, a $4.8 billion decrease. 8 days in a row, traders have been repatriating metal, some of them back to London, as a result of the reduction of U.S. import tariffs on gold. This is the first such run in 14 months. Demand is being driven by trade disputes, slowdown fears, and global tensions. Persistent drops in COMEX stocks may indicate a physical scarcity and lead to a price increase. Treasury Secretary Scott Bessent stated on February 3, 2025, that the United States intends to monetize the asset side of its balance sheet in less than a year. Although a revaluation of gold is not currently being considered, expert Andy Scheckman thinks it might eventually entail remonetizing gold. Highlights that global trade tensions, particularly US-China tariff wars, have rattled markets. Gold, a classic safe haven asset, is seeing increased interest as investors hedge against economic instability. The Moody's downgrade of the U.S. credit rating in May 2025 further fueled this trend. China's gold market is heating up, with speculators and central banks boosting demand. Reports suggest Chinese investors are diversifying away from U.S. dollar assets, and physical gold is a prime beneficiary. Earlier this year, fears of U.S. tariffs on gold imports prompted traders to stockpile bullion in COMEX warehouses. Now, with some tariff exemptions like those for Switzerland, gold is flowing back out, tightening U.S. supplies. Moreover, China has moved forward independently, rebranding the project as BRICS Bridge. This new version is already fully connected with 11 Southeast Asian countries and 5 Middle Eastern nations, collectively representing 38% of global GDP. The 17th BRICS summit held in Brazil's Rio de Janeiro has come to an end. The one big takeaway from the annual summit was that the leaders of the BRICS countries have decided to move forward on implementing a cross-border payment system, the main global interbank payment network. Gold remains central to the plan, signaling a shift toward a settlement system less dependent on the Western financial framework. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
I think gold is becoming central to a new system. Call it the skeletal system of a new monetary order, whether it be in the BRICS or whether it be in the United States. Last year, the Bank of International Settlements pulled out of Project Enbridge at the 12th hour. They had been developing it with the Bank of International Settlements Innovation Hub with China, Hong Kong, Thailand, and the United Arab Emirates. And the Enbridge technology is a cross-border payment system that allows for instant settlement, 7 seconds, a 98% reduction in fees, cross-border between central bank digital currencies from country to country, free from SWIFT intervention. And the fifth participant in the Enbridge technology is Saudi Arabia. And things were progressing to the point where Dilma Rousseff, the former president of Brazil and the head of the New Development Bank, the BRICS New Development Bank, said, we've agreed in principle to a new settlement system called the unit. It is a digital representation of a basket of 60% BRICS plus currencies and 40% gold, deliverable upon request. And things were progressing. And you could see that gold was becoming central to their theme. And we've agreed upon it in principle, she said. We're ready to roll it out over Enbridge, which is operational. And at the 12th hour, in what amounts to espionage, James Bond movie, the BIS, which is a Western institution, pulled out and said, we're pulling the plug on Enbridge. We can't, and mind you, this is largely a Chinese technology, although through the Innovation Hub it was refined and thoughts of rolling it into the Western system as well. And they say we can't be involved in any platform that will allow countries to sidestep Western sanctions. And so they pulled out. Now it's as if they just realized that Russia was the R in BRICS. And then things went very quiet. Now, since then, we've seen some very, very significant things that I think are largely being ignored by the West. And in particular, the new Enbridge, let's call it repackaging, it's called BRICS Bridge. And BRICS Bridge has now been rolled out officially by China. And they're calling it the renminbi cross-border payment system, first and foremost. So what I believe is happening is because Trump is putting so much pressure on the BRICS, they're kind of stepping out for a second, maybe waiting him out and letting China take the lead in developing the rails of this new system. And China came out about 3 or 4 weeks ago and said, and I've talked a lot about this, that, hey, we have connected with the new bridge technology, fully connected and integrated, 11 Asian countries, ASEAN, these are the countries from Southeast Asia, and 5 Middle Eastern countries. This represents 38% of global GDP.
Russian Foreign Minister Sergei Lavrov confirmed that several initiatives are underway within the BRICS framework to develop alternative, independent payment platforms. Crucially, he stated that countries outside BRICS will also be able to access these systems once established. At the BRICS outreach session, there is an ongoing work to create a cross-border payment and settlement infrastructure. And he emphasized the drive to build a more stable global economic architecture, anchored in multipolarity, where trust in Western-dominated institutions is diminishing. BRICS countries, he noted, are positioning themselves as key drivers of this transformation. The Shanghai Gold Exchange, SGE, officially launched its first offshore, international board-certified gold delivery vault in Hong Kong, and he believes this marks a major milestone in facilitating RMB-denominated gold trading and attracting global investors seeking physical delivery in a stable jurisdiction. While the Hong Kong vault is now operational, no confirmed updates yet on vaults in Saudi Arabia, under construction, Moscow, St. Petersburg, Dubai, or elsewhere along the Belt and Road are publicly available. These remain future objectives in China's broader strategy to build a decentralized, resilient gold settlement infrastructure. The new Hong Kong Vault, operated by Bank of China, Hong Kong, enables RMB-denominated gold trading with cash or physical settlement. Analysts see the launch, along with 2 yuan-denominated gold products, as a major step in Beijing and Hong Kong's push to expand global commodities trading and potentially erode Western monetary dominance. Let's revise the interview.
You had Sergei Lavrov, who was in meetings with Dilma Rousseff the year before, when they both came out of the meeting, said we've agreed in principle to this new settlement system called the unit. He's been closely involved in all of the BRICS meetings since day one. And a lot of the technology or a lot of the ideas, the infrastructure of how they would roll things out were his. So in any case, he comes out and says, we're going to issue this BRICS technology, this cross-border payment system. We're going to issue it to non-BRICS members, not just the BRICS. A lot of the pushback with the BRICS has been they're not big enough. When he said that, after they had already connected the Asian countries, it became very obvious that this is bigger than people are thinking. And I said publicly they're going to roll it out to the Belt Road Initiative, which it appears they now are. So what I'm getting at is that this system, which would compete with the SWIFT, will settle in 7 seconds, not the 3 to 5 days it would take these countries to go back and forth from dollars, from their currency to dollars and the other currency, and back and forth at a 98% reduction in fees. And they're going to open it to the remainder of the world. It's just not compatible with the pound, the euro, or the dollar. Subsequently, BRICS Pay is also being rolled out to the Belt Road Initiative, which is 75% of human population, 50% of global GDP. This is the cross-border business to business, consumer to business, small bank to small bank, the retail side of BRICS' agenda. Again, China is doing the central bank side. They're calling it the renminbi cross-border payment system, but it is the BRICS bridge. It is the M-Bridge technology. But rather than antagonize the president, they're letting China do it first. The key to the third piece of this puzzle, the key to it all, at the same time, we get the expansion of the Shanghai Gold Exchange into multi-jurisdictional vaults around the Belt Road, starting with Hong Kong. The vault is complete. The next one is Saudi Arabia, which is under construction now. The idea between all of this is to allow countries to trade cross-border with one another in their own central bank digital currencies. We already have 16 countries officially signed up outside the BRICS, the Asian countries and the Middle Eastern countries, and to settle imbalances in gold through a series of multi-jurisdictional vaults, whether it be the expansion of the Shanghai Metals Exchange, Hong Kong, which is operational. And by the way, the yuan is immediately convertible into gold, not having to first convert to dollars as you would have in the past. So they're saying, okay, China will trade with Saudi Arabia. They'll send them digital yuan for their oil. Saudi Arabia can then immediately convert that into gold if they wish. Right now in Hong Kong, soon to be in their own country, in these vaults as they expand through the Belt Road, very ambitious endeavor, but ultimately connecting to a whole series of vaulting networks, whether it be in Moscow, in St. Petersburg, in Dubai, the new BRICS Gold Exchange, Shanghai, and the vaults that we see throughout the world. It enables these countries to trade locally in 7 seconds, boosting their own monetary infrastructure, free from SWIFT intervention, and settle any and all imbalances in gold. It's genius. It truly is. And I really hammered this home over the last month. And then yesterday we get an article, or 2 days ago, from Forbes that pointed out that China is now just the third largest trading partner for the United States. And in May, their numbers were less than 6% of trade, which is the lowest level, Daryl, in over 20 years. And the article went on to say that the Asian countries, these same countries that are now hooked up and actually in operation with the new bridge technology, together have a population twice as large as the United States, over 700 million people. They have the fastest growing consumer markets in the world, the fastest growing middle class in the world, And as a group, get this, these countries are now China's largest trading partner by far, way ahead of the EU and the United States. Let me just say that once again. They're connected, and they're the largest trading partner of of China, and they can trade cross-border in 7 seconds with no swift interference, no swift recognition. They won't know what's going on, and any imbalances will be able to be settled immediately in gold. This is a massive deal for the BRICS. All right, so that more or less covers the BRICS side of things, where you have, in essence, an expansion of the Shanghai Metals Exchange connecting with other metals exchanges already in operation in Dubai and in Moscow, the new one that just was built in St. Petersburg. And the ambitious goal over the next year or two is to create this skeletal system of vaults, multi-jurisdictional, so it's not all held in one location like the Bank of England, who had the power to say to Venezuela, yeah, we're not going to give you your gold, thanks anyway, move along. So you want to be able to keep gold in various jurisdictions to mitigate any risk, and then be able to settle imbalances through trade through this entire network. It's important to remember that the Belt Road Initiative, these countries are not in the BRICS, nor is the Shanghai Cooperation Organization, the largest regional military and financial group in the world, or the Eurasian Economic Union, all the countries that end in STAN, a Russian endeavor like Kazakhstan. These countries are all very, very, very connected to the BRICS. In fact, the president of Belarus has been screaming forever that the Shanghai Cooperation Organization, the Eurasian Economic Union, should meld with BRICS. The Belt Road countries, 150 plus countries, 75% of human population, 50% of global GDP. They're not in the BRICS, but they are very connected with the BRICS.
A changing global financial order is indicated by rising physical gold demand, COMEX outflows, and strategic actions by China and BRICS. Gold is recovering its monetary significance as the United States deals with trade conflicts, credit downgrades, and possible balance sheet monetization. A shift towards settlement methods less dependent on the dollar and SWIFT is indicated by China's offshore gold infrastructure and BRICS-led payment systems. With gold at the center of a new trust-based economic structure, this multipolar movement has the potential to revolutionize international trade. Will the BRICS gold-based payment systems hasten the demise of the US dollar as the world's dominant currency? What effect would persistent COMEX gold outflows have on world gold prices over the upcoming year? Let us know your thoughts in the comments. If you enjoyed this video, give it a like and subscribe for more updates. Thanks for joining us on this journey.
Silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver right now with silver, where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold, and gold has got this little pause that it's just had, and now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth.
With $44 as the next objective, silver is currently in a great setup for a breakout. It may reach as high as $49.50 an ounce in a traditional parabolic. The story is being driven by breakthrough technicals, tightening supply, and industrial demand. According to Investing Haven's forecasts, silver will first challenge all-time highs, reaching about $49 in 2025. Money is shifting right now. Investors are pursuing silver and gold miners who have been rising in value, and gold has just rebounded, so they are taking profits there. In order to prepare for the next step higher, miners may now pause as profits are taken. This money might then turn back into gold. Chris Vermeulen is a market strategist and technical analyst. He points out that silver is in a good position. According to a recent commodity forecast, bulls are aiming for $44 if resistance is broken, and silver is now trading close to $42. Although silver is more speculative than gold, both are expected to continue to rise as a result of this rotation. Silver is breaking out, according to technical breakout assessments, both in terms of its absolute price and in relation to stocks from 4-year bases. In certain technical models, medium-term targets of $49 to $50 are repeated. At the same time, gold's consistent increase serves as a warning to markets about anxiety around the world. While IT giants continue to drive U.S. stocks to near-high levels, internal weakness and exuberant sentiment point to the possibility of a significant correction in the near future. There are fissures in well-known industries, momentum and investor confidence are brittle, and valuations are high. Analysts warn that some profit-taking and sideways moves are typical following strong runs, in miners or metals. Although resistance has been breached by silver, further upside is contingent upon maintaining volumes and avoiding reversals. Chris believes when the cycle changes, investors need a strategy to identify trend reversals and safeguard their money. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Yeah, if we take a look at silver, we haven't traded silver just because gold, our play around silver was the silver miners. And so silver has done the very similar to gold as it's rallied up, and now silver's had a nice bull flag. It's paused. And so silver's breaking out and starting to run. So money's coming, I think, out of miners now and starting to go into silver. And then I think it'll bleed over into gold because silver is much more speculative than gold. So money's going to rotate probably from miners, silver, gold, and then kind of maybe loop around. These are very nuanced, small moves. But silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver, we're in a sweet scenario right now with silver where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. You cannot trust a move that goes straight up because usually it comes straight back down. Very similar to what happened just before the last financial crisis. It shot straight up, came straight back down, and then sold off for 65%. So I think we have that potential for it to shoot higher still. And of course, that'll be good for silver miners as well. But yeah, right now we're in that sweet spot for precious metals. And you and I have touched on this cycle graph before. If we look at the stock market, this blue cycle here, precious metals really come to life near a major market top. And one of the reasons is people are moving away from the stock market in general, and they're moving into physical assets, something where they won't lose value or won't blow up on them as much. And industrial capital goods are actually doing really well. When we look at the industrial space, businesses are still bullish, and industrial stocks are rocketing higher. Businesses think things are good. CEOs and factory workers or management are upgrading their facilities, thinking this is a little lull maybe for a lot of businesses before it goes higher. But I think the music's about to end, and when everybody's really bullish and they think businesses is just getting started, usually that's when the business goes for a nosedive. We go in for a recession, and they realize they just spent millions on new facilities or assembly lines and all that stuff right when all their demand decreases. So there's a lot of things coming together. And yeah, there's a few key currents. I think looking at the big picture might be important. I think the stock market is getting pretty frothy. If we look at the charts, we'll actually take a look at the big picture and actually go to gold first. So gold, in a nutshell, I'm just going to flip to the monthly chart. Gold has been on a tear, for a couple of years. It's outperforming. It's becoming one of the best performing assets long term. Last time we saw this was like in 2007, just before a major stock market and financial reset in the economy. Gold is kind of a barometer, a global barometer. Like planet Earth and the people on it's like a beehive mentality. The whole world is nervous that something is about to happen, and they tend to move to gold. They move away from equities to some regard. They move away from currencies. They move away from even real estate, and they start to move to gold. They want something physical, something outside of the financial system, and gold is telling us that people are preparing for something bad to happen. We don't know what it is. We don't know, when the shoe is going to fall, and trends are going to change. The economy situation is going to change, but gold has just been on this tear, and it's outperforming and it's extending to the upside. That is an early warning sign to be careful for the stock market. But if we zoom in now and go to the overall stock market, I'll go to like the SPY, which is the S&P 500 ETF. We've obviously had a very nice rally coming out of the lows from this year. We had the big 20+% sell-off. Now the markets are pushing near hitting all-time highs, and really people are buying into this market up here. I think it's kind of camouflaged with, Oracle has now kind of just came out of nowhere. And, Larry, he's like, you never really hear much about him, it seems,
Mm-hmm.
Now he's the wealthiest man in the world and he's like silent. And Oracle came out, and I think it's going to revigorate, some of the tech space and make people even more bullish on the market. And of course, it jumped like 30+% the other day. And so the markets are getting dragged up mostly by the big techs. We are seeing some broad market rally. We're seeing small caps. They've been moving up and equal weighted, but it still is really the magnificent seven. And so the stock market is in an uptrend. You do not want to fight it. You just need to have a game plan so that when things do stall out and price starts to roll over, first of all, you can identify when the trend up has come to an end, and to have a game plan to at least avoid a crash or benefit from falling pricing. And then if we zoom into the shorter term here, Danny, we just look at the 30-minute chart, really over the past week, the stock market has gone from this lime green, this oversold market condition where it's sold off too quick within this uptrend. Lime green is an indicator, is part of an indicator that tells me when the market is too oversold, is usually when value hunters step in, bargain hunters or institutions, and they buy it back up, and you can see it's rallied. And it's done this a couple of times. When we just zoom back here on the S&P 500, it can get sold off, it can get into this oversold condition, and it gets bought right back up again. So we're still in kind of that buy the dip mentality. We did have an interesting scenario yesterday where we had this red indicator, get above this blue line. This is my FOMO indicator. This is everybody seemed to be piling into the market yesterday. They don't care what price they pay. They're using market orders, which means they're buying at market and they don't care what price they pay. When there's a ratio and this red indicator goes over 3, it's telling me that people are just moving in and they believe the market's going higher and they don't want to be left behind. And so usually after that, we have a little bit of a pause or pullback. And really it's kind of, as soon as we got up into that territory, the market's really been trading sideways for this last day and a half. We might actually see it pull back a little bit for another day or so. So, you look at long-term gold, be aware the music will come to an end at some point. We look at the daily chart. It's up, but it's a very weak market.
Chris Vermeulen emphasizes that gold has had a strong run recently and is now pausing in a sideways bull flag, which often signals it's ready for another breakout soon. While money has rotated into silver and gold miners, those positions may see profit taking, with flows cycling back into gold. Chris prefers gold, whether physical or through ETFs. They warn that if equities drop sharply into a bear market, even gold could face temporary selling pressure from panic and margin calls, but it usually recovers faster than stocks. Current conditions resemble 2007, where gold continued to rally even as equities topped, suggesting more upside before any broader correction. Let's dive into the interview.
No, so if we look at gold, all it's done is, we can look at the 30-minute chart over the past week and a half. Gold has had this a very strong move, and after something's had a strong move, it's just taking a pause. I wouldn't say it's weakening; it's just taking a breather because it just had a hell of a run. It's exhausted. Right. There's just some profit taking, and so when we look at the daily chart, which is very similar, we're just trading sideways, and it's a little tiny bull flag. It's primed and ready to shoot up. Literally, the next trading session, this thing could pop and run. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners, you can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. And, I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold. And gold has got this little pause that it's just had. And now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth. That's what I think is going to unfold here. The problem is we're coming to a turning point. And when things turn, I don't want to hold anything. So I still like gold the most, physical gold or through an ETF. I think that has got good upside potential here. I think it still has 10 to 20+% upside. I also think because I have to hold it for a year, I think bonds like TLT would be a good position as well. So the bonds could come to life and really start a nice move up. And eventually it'd be nice to sell gold. And because when the stock market does roll over, eventually gold will most likely pull back with it. But gold holds its value fairly well. It doesn't drop as much as the stock market. So I would say like gold and bonds would be those plays. If you had a gun to my head and said you have to buy and hold, it's probably the two that I would do. Short term, typically we see gold, like we could see the stock market top out and potentially fall 10, 15% from here. And gold keeps going up another 10 or 20%. But eventually when the stock market falls a certain amount and people start to get really scared, there's real fear, we actually enter a bear market, then gold usually doesn't stand a chance. There's enough selling and margin calls and fear that even people sell off the good positions like gold. And so gold naturally will sell off temporarily, but it's usually short-lived. Gold only gets pulled down during an extreme wave of selling. It could last a few months in the markets, and then it'll find a bottom way before the stock market does. So yeah, gold is not immune to a bear market, but it can rally in this particular situation. 2007, which is a very similar situation as we have right now, when you look at from price charts and what the dollar is doing and what gold's doing in the stock market, the equities market could sell off and top at any point here, and gold just keeps on going another 20+%. So that's why I like gold at this point.
It is more crucial than ever to have a clear plan in place to safeguard profits and handle reversals as global uncertainty increases and stocks reveal underlying fractures. How likely is it that silver will maintain its pace toward $50 without seeing a dramatic reversal if it breaks over $44? In the event that U.S. stocks undergo a more severe decline, may gold and bonds serve as the most secure hedge? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
The U.S. government has moved to impose tariffs on deliverable gold bars, reversing previous expectations that bullion imports would remain exempt under President Trump's reciprocal tariff structure. A July 31st CBP, that's the tariff organization, letter reclassified the bars as, quote, semi-manufactured, making them subject to duties under Code 7108.13.5500. This decision sparked a surge in New York gold futures, where December contracts traded over $125 above London spot before easing back into what you see there. Switzerland, the largest exporter of kilo bars to the U.S., faces heightened trade pressures following a 39% country-specific tariff.
The U.S. Customs and Border Protection ruled that 1 kilogram and 100-ounce gold bars from Switzerland fall under a tariff-bearing category, overturning prior expectations of exemption. This threatens Switzerland's position as a central refining hub and could disrupt global bullion markets, making them subject to tariffs ranging from 10% to 39%. This move disrupted the international gold market, with the London-New York price spread surging to over $100 per ounce compared to the usual 30 cents. A major gold refinery in Switzerland halted deliveries to the U.S. following the CBP ruling. The change could fragment the global gold market, prompting buyers to shift toward non-Swiss bars at premiums. It also puts pressure on CME Group to address delivery issues for futures contracts. If upheld, the tariffs may reshape gold trade flows and force costly supply chain adjustments. Renowned market analyst Vince Lanci is known for his perceptive analysis of trading in commodities and precious metals. He discloses that certain huge gold bars, 1 kilogram and 100 ounces, are currently subject to tariffs from the United States. These bars are frequently used in EFP transactions as well as wholesale bullion trade. UBS is cautioning that the increased costs of these U.S. taxes on massive gold bars may lead to a mass closeout of short exchange for physical positions, which could cause disruptions in the funding markets. The unwinding of these trades, which are typically settled in London, may complicate funding circumstances because it would create an unexpected demand for cash and liquidity in the city's bullion market. The apparent decision by the U.S. Customs and Border Protection Agency, announced privately in a letter to a Swiss refiner on July 31st and made public on Friday, sent gold futures in New York soaring to a record, as insiders warned that the tariffs would have dire consequences for the market. Then, just as quickly, prices tumbled after the Trump administration suggested imports of gold bars wouldn't face tariffs after all. In the 12 months to June, Swiss exports of gold to the U.S. were worth approximately $61.5 billion. Switzerland's rate is among the highest in the world, after Brazil, Syria, Laos, and Myanmar. According to reports, gold bars were in such high demand in the U.S. in May following Trump's announcement of sweeping reciprocal tariffs the previous month that Costco capped the number of gold bars that could be purchased in a day. Let's jump into the video for more details. If you like what you see, please give us a thumbs up and subscribe to our channel to stay updated on our latest content.
Refiners in Asia have also paused shipments as uncertainty spreads. Industry experts warned the move could destabilize the gold futures market's pricing function, with UBS and BNP Paribas strategists questioning whether the ruling was an error or a fundamental policy change. To put a little bit of color on the mechanics of what is going on and why this is affecting the market the way it has, before giving you a very simple big picture overview. London deals mainly in 400-ounce bars. U.S. contracts are for 1 kilogram or 100-ounce bars. During COVID, the problem that's happening right now also arose. When there is demand for U.S. delivery, London bars are sent to Switzerland to be re-refined or refabricated into U.S. formats. London has been the default physical hub for gold for decades, while the U.S. has focused on making a more robust futures market. Dealers in London are typically long metal in their vaults in London and hedge by being short U.S. futures through the EFP carry trade. They are long London gold, 400-ounce bars, and short U.S. gold, 100-ounce bars. If U.S. delivery is called, which historically is rare because the COMEX is a paper market, and everybody knows that you should want to get your metal from London, they would take the metal that they have, their 400-ounce bar, send it to Switzerland where the refineries are, have the Swiss break down the 400-ounce bar into 4 100-ounce bars, changing the format, satisfying U.S. rules. The new tariffs disrupt that trade. A London trader, long gold and short U.S. gold, long London gold and short U.S. gold, now faces a choice. First of all, London traders have been doing this for years. They're long the physical and they sell futures against it legitimately to carry the differential. It's kind of like lending money out. Gold is money. And they get comfortable doing that. and it gets to be a crowded trade. It gets to be a lopsided trade. And so they have these large legacy positions that they're always massaging. But when news like this comes out, and you can't take your 400-ounce bar and put it into four 100-ounce bars to ship it to New York, if someone ever wants the physical, you have a problem. You can find another refiner, not possible overnight. I wouldn't give you any. Squeeze the shit out of you, excuse me. You could do nothing and die a painful death, or you can buy back the US contract quickly. So they're short the US and they're long London. So they buy the US contract quickly, and then they decide whether or not to sell the London contract. So it's a regulatory contract issue. If somebody in the US were to say, I want the gold, as we have been doing, well, then you would have to get the gold. The driving behind the price higher is this covering or this unwinding of the EFP, which is really just a spread between London and New York. This exposes the weak link in the triangle of trade. London acts as an intermediary, but problems in metals markets over the last 5 years, gold, silver, and nickel, for example, and copper, have been venue or fungibility problems. Again, very similar to what happened during COVID. Supply chains that are too long are being shortened. Now, to zoom out on a little bit of a big picture thing here, because this is all part and parcel of what's been going on over the last 3 years.
Vince points out that the conventional relationships between the US and London gold markets have been upset by this sudden action. There was a notable pricing disparity, as New York futures reached all-time highs, while London spot prices remained essentially unchanged. For example, London spot prices closed at $3,439.10 per ounce, while December gold futures hit $3,534.20 per ounce. The White House announced that it would issue an executive order to clarify its tariff position in response to market turbulence. The goal of this action is to clarify any confusion and establish stability in the bullion market. The current state of affairs underscores the intricate relationship between international commodity markets and trade policies. As the U.S. administration seeks to assert its stance on gold imports, the broader implications for the gold market and its participants remain to be seen. The White House's upcoming executive order should hopefully clear things up, said the logistics source. Protecting the U.S. gold futures during this uncertainty are high stocks of gold in COMEX-owned warehouses after massive inflows over December-March as traders hedged against the possibility of broad U.S. tariffs hitting bullion imports. The COMEX inventories currently amount to 86% of open interest, against a more normal 40 to 45%. So there is no liquidity issue at present, said StoneX analyst Rona.
With copper earlier, London spot prices were largely unaffected and are now lower. This reflects the weakest link in the triangular gold trade between London and the United States, as I just said. Moving on to the immediate potential effects. If the move is intentional, it is a game of chicken with the potential to disrupt the gold market at the financial side substantially. The negotiation is with Switzerland, but it highlights that Western gold's trade weak point is physical supply in London, while Western demand is increasingly in the US, pulling the gold over here. The supply chain must shorten. Because gold is also money, restricting its movement is weaponizing our payment chain. If unresolved quickly, this will push market participants into their own corners, taking their kickballs and going home, but more aggressively, make global trade more fragmented and bilateral, with every deal negotiated separately. If Trump meant to do this, he could still adjust course, as he recently did with copper, depending on the reaction. The Swiss have already offered, as we said, at least verbally, to consider moving refining capacity to the US. It is unclear how serious that is. If it was unintentional and the result of a classification error or Trump just bluffing to see how they'd react, the decision could be reversed within days. For now, given the opportunity, this is effectively a coin flip. Traders might use this as a point to close positions, winning or losing, until there is clarity. The implications are significant, but the core story is here. Related posts. By the way, that full story is in Tariff Shock Triggers Historic Gold Market Location. The link is there. Related post. Last night we put it out. U.S. imposes tariffs on Swiss gold bars. Yesterday we also put out UBS raises the 2025 demand roof. Suspicious, no? Founder special, Fed death, gold industry coming to America, as we thought would happen. Swiss offer U.S. its gold industry and trade talks, and the must-watch report from yesterday. Okay. We have a little note here we just want to say. Isn't it interesting? I won't say the word suspicious, that within days of each other, the Fed weighs in on gold revaluation. The LBMA is exposed as a weak link while we're trying to repatriate our own gold supply industry. These things point to potential revaluation of gold. They definitely point to a deepening and a realization of the importance of gold in global trade going forward. They show the LBMA problems, and we need to secure our payment and supply chains for gold if we view it as an international asset that's needed. Other metals would follow. In 5 minutes, he could reverse this and say, I didn't mean it. And you could think that he's either screwed up or bluffed. And you'd say he's a dummy. Or, and this is equally true, Trump has a habit of, most government does, but Trump has a habit of shooting and then aiming. So perhaps he shot and aimed because he wanted to see how they can react. You know, when you're the incumbent, you get to make those mistakes. That's why Microsoft software sucks, because they can put it out and then fix it later on. Anyway.
This steep tariff on Swiss gold bars marks a significant escalation in U.S. trade policy, potentially reshaping global gold flows and driving up domestic prices. With high demand already evident, as seen in Costco's purchase limits, the new levy could further tighten supply and increase costs for American buyers. How might these tariffs impact gold prices in the U.S. over the next year? Could this lead to increased smuggling or alternative sourcing of gold? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.